border resistance. Which I'm not a fan of. But if you look at this example here, each one of these sets of horizontal lines is an individual new week opening gap. You can see how price gravitates towards them. It may pass through them like a hot knife through butter. Sets of
Make sure you have it ready for me by 8 a.m. Yes, ma'am. I'm gonna go put this back in. Hello. I'll be back, home. Don't get scared. Where's Sticky? Cállate la boca. Vámonos, chinga tu madre. Nobody can straighten out.
price.
Where's Sticky? Cállate la boca. Vámonos, chinga tu madre. Nobody can straighten out.
or reach them, consolidate around inside of them, and then expand to the next one. If you've ever used pivot numbers, okay, it used to be the floor traders pivot numbers. I used to use them habitually. I abandoned them for better tools and such, but if you think about how back to finding real value in price action. So when we look at price action, if you strip it back to retail logic for a moment, traders are usually trying to buy support and trying to short resistance. And my agenda has always been trying to get to the root cause or the underpinnings of the marketplace and look for like draws on liquidity, areas that price should support or resist, and the logic behind it should be sound, not some randomly selected support or resistance level, be it horizontal or diagonal trend support or resistance, which I'm not a fan of. But if you look at this example here, each one of these sets of horizontal lines is an individual new week opening gap. You can see how price gravitates towards them. It may pass through them like a hot knife through butter, or reach them, consolidate around inside of them, and then expand to the next one. If you've ever used pivot numbers, okay, it used to be the floor traders pivot numbers. I used to use them habitually. I abandoned them for better tools and such, but if you think about how the pivot numbers used to act, and sometimes still do, act as a magnet for price, just like a draw on liquidity. Equal highs, a single high when it's bullish, price will invariably want to reach up above that old high for the buy stops, or reach down below an old low or relatively equal lows for the sell stops. So that draw on liquidity, that same effect, that magnetism on price, is seen with new week opening gaps. I want to talk a little bit about opening prices. Now, openings are not random price events. It means that wherever the first opening trade is, the first tick of the marketplace, when the new week opens at 6 p.m. New York local time, that price is absolutely not random. And the proof of that is to watch how price respects it throughout the week and in the future, in weeks and months ahead in the future. So I want you to think about the importance of knowing what the opening price is on Sunday. And I've taught in other lectures how it's important to take that Sunday opening price and extend it through the entirety of the current trading week that you're about to start or what you're presently trading in. At the time of this recording, it's Sunday, May 7th, 2023. The price that we open at 6 p.m. later on this evening, that price I will extend throughout the entirety of this trading week. But the entire new week opening gap, high and low, that range will be projected in the future for many weeks. So you can see the relationship of where that opening price is here on March 5th, 2023 at 6 p.m. That opening price is what I'm annotating. So to find the opposite end of the new week opening gap, we can see where price was on the previous Friday. So we're going to have to look at the difference between these two price points here to come up with the new week opening gap for March 5th, 2023. Much in the same vein that opening prices are not random price events, closing prices are not random. Now, it seems like buying and selling pressure, if you read all the books and listen to other people talk about it, the talking heads in this industry that are supposedly technical analysts, they'll tell you that price is random and no one can predict the price. No one can know what price is going to do. And many times my students have watched and observed how price really respects these new week opening gaps, not just the very day that they form or that particular week, but weeks and months in the future. let's take a closer look at that particular Friday, which is March 3rd, 2023. That's the last closing price before the session ends on that Friday. So now we have 2 price points here. So we have the opening price on March 5th, which is a Sunday. You can see that over here. And then annotating the Friday closing price. Between those 2 price points, that's what the new week opening gap is. So an ICT new week opening gap is this very separation between the 2 price points. Now, because Friday closing price of that March 3rd, 2023 is above where we opened on the subsequent Sunday opening price, that means that Friday's closing price is the new week opening gap for that gap. And then the opening price on Sunday is the low of this particular gap. If the roles were reversed, if we opened above wherever we closed on Friday, then obviously these labels would be diametrically opposed. Extending the new week opening gap into the future price action. So you can see here using that March 3rd and March 5th new week opening gap. Let's take a closer look here. Here's that same gap, and we've extended it through into the week. And you can see how price has treated it as resistance, pulled away, rallied through, came back down in. Notice that it's 2 passes. There's a separation between these 2 price points. So buy side was offered here. What's lacking? Sell side. So movement on the downside. There it is. So now price tries to move away, runs buy side, trades below the short-term low here. And notice how it's gravitating back and forth around this new week opening gap, but still respecting it. See all the candles here individually? These are 5-minute candles, by the way. Market trades up, finds some support here, and then springs higher above for buy side, trades all the way up to a old new week opening gap, trades to that new week opening gap low. I'll leave this price levels here for you to go and do your homework and find out what that new week opening gap is anchored to. Hits resistance on that new week opening gap low, trades down, goes right back over top of the, at this time in the price action that's being shown, this is and will be considered the current, not the time of this recording, but the current in this fractal in terms of this chart, how much data is being shown. These 2 lines here is that week in history's current new week opening gap. It returns all the way back down to it. So see how price treats these new week opening gaps specifically, as magnets. Okay, it creates this willingness to want to go right back to them, and it's a fair value function in price delivery. The gap is not a random event. It's engineered, it's designed, and then smart money uses these old reference points throughout the future week of trading, the future month of trading, and for several months in the future. So the market finds some support here, rallies away, and consolidates around and draws right back down into that new week opening gap once more. Trending signatures with the new week opening gap. So if you think about when a market is indicating that it really wants to run away and trend. There's lots of things I've read over 30 years about what makes a market want to trend and consolidate. And one of the things that I've learned is with this new week opening gap, you can see here, this is that same week extended forward. And then look at what we've done here. We extend the amount of time inside that new week opening gap, and then it aggressively runs lower. Whenever there's a sudden move away like this, that indicates that we are entering a trending market. Notice how we moved away, yes, but only went up to a new week opening gap just to find resistance and went lower and returned back to that current week's new week opening gap during the week of March 5th, 2023. Here, aggressive movement away. That means we're going to be trending. And look how much we trended away from that new week opening gap. Now, contrast that with looking at a larger fractal of that price action. This is the hourly chart now. Here's that same new week opening gap and that movement away. Look how much price movement we've seen move away using this concept. So it's allowing you to have a X-ray view behind price. What is it likely to do? If we're seeing it showing willingness to sharply move away from the current new week opening gap, then it's likely that we're entering a trending model. That means the market can move longer and more magnitude behind the price moves instead of a small little scalpers consolidation market. Consolidation signatures with new week opening gap. And obviously I just mentioned how I like to look for a willingness to sharply move away above or below a new week opening gap, that current new week opening gap. So whatever the weekly open separation between Sunday's open and previous week's Friday's close of the current week or the week to come, okay, that's always going to be referred to as current new week opening gap. If price has a unwillingness to move away and just keeps coming right back to that current new week opening gap, then we're probably going to be range bound and consolidating. So you have to be a scalper. You have to be a little bit more nimble in your trades and not expect to be trending. If you look at this example here, another characteristic of a consolidation market is when there's a multitude of new week opening gaps converging within that range. You can see here, this is a new week opening gap high, this is a new week opening gap low, this is a new week opening gap high, and this is a new week opening gap low. I did not draw another one to show the difference between this closing price on this candle and this opening price here. I used a rectangle to shade it. So that way you can see the separations between the three new week opening gaps that's actually being shown here in this price action. So the new week opening gap for this amount of data for this particular week in history during the week of April, the new week opening gap would be this closing price here on that Friday, and then the opening price down here on Sunday. So that shaded blue area here, that represents this amount of data that's shown on the entire chart here. That would be the new week opening gap for that week, or will be considered the current new week opening gap during this week in history. It's not the present one right now because we're in May, but I'm showing you in the past how when there is a convergence of multiple new week opening gaps in close proximity to one another, the markets will tend to enter into this range-bound environment. So it helps me as an analyst and as a mentor teach my students and kind of point out in advance we're going to be likely to range-bound. It's not going to be a big moving market. It's going to be range-bound. So you have to be a scalper. Now, that's not to say that there isn't significant price moves in this consolidation. It just means that we're not looking for one-sidedness that lasts for days and weeks. We're looking for highs and lows to be violated and pull back into the middle, which is what? That blue shaded area. Every decline keeps drawing right back inside of that blue current new week opening gap. Every rally above it keeps seeing it come right back down into it. Expand above to take out the buy side here. Where's it go? Right back down into that blue shaded area. If it goes beyond that, where's it going to go? It's going to go down below inside of the old new week opening gap that's in close proximity to the other two. So it's important to have them kept on your chart and keep one chart that's separate as a template. Label it as new week opening gap, and that way you can constantly refer back to where we are in terms of these like magnets on price action. Now, by themselves, you don't just simply look at them and say, okay, price is going to go there. You have to incorporate other factors that I've taught on this channel and during the core content or what I've taught in the 2022 mentorship model. But all of these factors blended together gives you a better understanding of where price is likely to draw to. Not just simply an old high or an old low, but incorporate these old new week opening gaps or the current new week opening gap, because the price will absolutely treat them as a magnet and go back to them, retest them, and then maybe many times spring away to offer you a short-term scalp or maybe even a trending model. Navigating price with new week opening gap. All right, so you can see here, this is actually a current fractal in price action. This is showing the Friday non-farm payroll for May 5th, 2023. You can see here we have an old low where sell side would be residing, and then an old low here where sell side would be residing. This market trades down below both of them. We also traded down into an area that would be considered a fair value gap on the daily chart. I also mentioned it during commentary during Twitter. Going into non-farm payroll, ahead of it actually. And then the market gyrates and gravitates around this new week opening gap from March 3rd. Now think about it. We're in May, the 5th day of May 2023, and using levels from March 3rd and March 5th, just those two prices, the Friday's closing price and the Sunday's opening price after. So we're extending that throughout time. Look at the sensitivity here. Look at the closing price on that candle. Look at the low on that candle. Look at the bodies of the candles in here. Look how it's respecting it in here. Look how all the bodies are just stacking above the high of that old new week opening gap from March 3rd of 2023. Then we move higher, come back down in. We have the non-farm payroll event. Price rallies and gravitates to what? This new week opening gap. This is the closest one in proximity. Then it reaches for the other above it. It trades to that, comes back down in, fills that fair value gap, and expands away, reaching into the consequent encroachment of this wick and revisiting back into this civvy here. So there's a buy side above that. We'll see if it wants to reach above that nonetheless, but you can see how price wants to move to these levels as a magnet. They could be mile markers or they could be ultimate targets. Mile markers meaning that it's just reaching for that one initially, and let's see if it can reach to the next one. In your notes, I want you to write down that if we have a new week opening gap and it's likely to go higher, between the two of them, halfway point, if price can reach that far, probabilities are that it will probably reach to the next new week opening gap in the series of the last several weeks and months of new week opening gaps that you would keep on your chart. Looking at it closer, here's a 15-minute time frame. Fair value gap in here, laid over that same March 3rd, 2023 and March 5th, 2023 new week opening gap. Now you're wondering probably, why am I using this one? Well, this happens to be the new week opening gap that runs through all of this data. So in your notes, you want to look at, if you're seeing price in consolidations, or if you look at a cluster of price action, go back through time and see what new week opening gap extends through that area. Which brings you to the question, how many new week opening gaps do I use in my charts? Whatever today is, in trading, I look back 60 days. Now, for those that have gone through my core content, you know in month 5, which is a lot of content and a lot of material, and most people that are coming under my wing as a developing student with my knowledge and concepts, they usually tap out during that month because it's pretty intense. And there's a concept that I teach, the IPTA data range, and it's the 60-day look back and the 60-day cast forward. So whatever today is, I look back 60 days, and whatever new week opening gaps have formed in the last 60 days, that's how far I'll look back, and that's the maximum I have on my charts. But I counsel you in the first part during this mentorship in 2023 on my YouTube channel that you want to have at least 5, because that kind of gives you, right now, the ones that are most salient as a new developing student. As you improve and you consider more information and more data, you want to look back using that 60-day look back period that I used for IPTA data ranges. As I mentioned when I taught the content to my paid students, many of them discounted it like it was of no concern. There was no reason for them to even worry about it. It made no sense to them. But obviously, with more information being presented and ongoing education, you can see how those 60 days look back is a major impact to my analysis of what I'm using, how much data am I using, which PD array am I going to consider still valid, all those things. A fair value gap, for instance, if you go back 60 days, a fair value gap 60 days to me is still valid. And it's still valid even if it's already been filled in. So I'm not the average person out there that could see an imbalance in price, and once it trades back up and quote unquote fills it in, they're done with that. I'm not. The algorithm's not done with it either. It's going to refer back to it and respect that same old level because of the time aspect that's incorporated in algorithm price delivery. So hopefully you found this one insightful and it added some more insight into new week opening gaps. And until I talk to you next time, be safe. All right, folks, welcome back. This module is going to be discussing my new day opening gap. Okay, just like we discovered in the new week opening gap, the new day opening gaps openings are not a random event either. So we're going to take a closer look here at a new day opening gap opening price. Okay, so we're looking at the 3rd of May, 2023. You can see the 6 p.m. restart. There's an hour break in futures trading. And you can see that actually occurring here in this chart here. It's a 5-minute chart. So the opening price is the very first tick or traded price. That's not random. It's offered to the market, and whichever trade gets filled there, that starts the beginning of the new day opening gap. Then we look at the closing price from the previous session. And as we mentioned before, closing prices are not a random price event there. So new day opening gap, the closing price of the previous session here. So this is the 5 p.m. session. Now this NDOG, or new day opening gap, forms every day, Monday, Tuesday, Wednesday, Thursday, and then Friday. We don't have it there because we have the new week opening gap, the difference between where we close on Friday and where we open on Sunday. So here's the closing price on the previous session at 5 p.m. And then 1 hour later, we reopen in the futures market at 6 p.m. So that's our new day opening gap. Now I call this May 3rd because it's in my time zone, the 3rd. Midnight on the 4th, that starts my May 4th. But this is all factored as part of May 4th's trading on TradingView. So that way it's not a point of confusion. Between the two price points here, this is your new day opening gap. Now we're going to extend the new day opening gap into future price action. Okay, here's that same gap. I just put more data on it. This is from Wednesdays, 6 p.m., my local time in New York. That gap that's created a new day opening gap, I've extended it through the 4th and non-farm payroll Friday. I want you to pay careful attention to seeing how price is respecting that new day opening gap. Here as support, we come down, support, resistance, consolidates around it, equilibrium between the high and the low. See how it's gravitating around that? And look at the difference, how price comes back down into here. So we offered this buy side, then we offered this sell side, and then it rallies up, trades into inefficiencies here, sells off, and you saw me actually show all of the trades in here with all of this information as well in the previous review, and creates resistance here, resistance once more, multiple times resistance, support, sweeps the stops, rallies, resistance, support, digs down one more time into it here, and then sends it higher post non-farm payroll data. So I want you to think about how I taught the new week opening gap and how we can use as many weeks and multiple months, looking back 60 days. The new day opening gap sometimes may not actually form. There may be very little separation between where we close at 5 p.m. and where we resume opening a new trading session at 6 p.m. This pattern that forms with this new day opening gap may not be an everyday event. So if it's not showing a meaningful separation between the two price points, I won't even utilize it. Okay, so if it's like one tick, or like 2 ticks, I'm not terribly excited about that. It can respect it, but I generally don't like to see those types of new day opening gaps. I prefer to see a separation like this, okay, where it's much more meaningful. You can see a real separation. There isn't a specific number of handles or points that I like. I just don't want it to be less than, preferably, it's got to be at least more than one handle. So carrying the data forward and casting it throughout the entire week, once that week closes, I'm not interested in that new day opening gap. So in other words, this has been utilized last week. I'm not interested in these two levels now going into a new trading week. So in my opinion, in my own analysis, the new day opening gap, I'm only interested in for the week. When the week ends and we start a new week, I'm going to utilize the very first new day opening gap, and I'll extend that throughout the entirety of the week. If you go through your charts, you'll see for ES, there wasn't really any other meaningful new day opening gap except for this one here. And look how it was treated into Thursday and Friday's trading. once it closes the gap, that's not a point of abandoning the gap. Okay, we refer back to that area again in the future, and you can see how price gravitates around that here, and it's hard to argue against the idea that these levels will be, at least for the week, impactful support or resistance levels, if you want to call it that. I just like the idea of it repricing to very specific PD arrays. When it touches it, it's not that it's touching here and acting as support to go higher. It's going down, and there's a confluence between that old new day opening gap low over here where it opened at 6 p.m., extending it forward. What's also here? A fair value gap in the form of a buy side imbalance, sell side inefficiency. So from here to here and dropping down, that's optimal trade entry, OTE. It's a fair value gap, and it's also the time where it closes in that gap with a retouch to that new day opening gap low. It finds some support, rallies up, and hits it one more time here, taking out sell side. One more time, relative equal lows here. What's below that sell side? It digs below that. During the London session on Friday, rallies, hits it as a high. What do we have here? Low, high, lower low, bullish breaker, trades into it here. After hitting that fair value gap, bullish breaker, rallies and digs back into what? The breaker, but also respecting because the bodies didn't close below that new day opening gap high. So the wicks do the damage, but the body tells the story. The bodies of these candles were not willing to even close below that swing low. So we dug down into this old new day opening gap high, allowed price to send it higher, fair value gap, order block, and then starts to rally. New day opening gaps, I like to see them act as a supporting factor or a resistance to an idea that I have already arrived at with other PD arrays or other analysis concepts. So it's not a be-all end-all, it's not a panacea. It's just one of those things that I like to add to. And also, if it hasn't already done this new day opening gap reprice to the high of it here, and this is reverse for when it gaps higher too, same thing. I'd like to see it trade up into and reprice that. So that's right here would be a really easy trade where we open, we trade down, consolidate around the low of it with the gap here. So trading up to the high of that new day opening gap would be a very easy bread and butter type scalp. And that would be like an Asian session trade that you can utilize if it's a time of day where you can study or look for opportunities to tape read. Hope you found this one insightful. Until I talk to you next time, be safe. Good afternoon, folks. Welcome back. I'm going to talk about the ICT sick sister concept. So if you were confused by today on Twitter, I'm hopefully going to be able to wipe away some of, if not all, the confusion pertaining to my sick sister concept. I'm going to show you why I chose to use the NASDAQ today, and I'll start off by saying that the economic calendar this week is heavy-handed on the Wednesday, Thursday, and Friday. So Monday and Tuesday is lacking any real meaningful medium or high impact news drivers, so it's expected to have these consolidation days, which is what we're seeing here. I don't look at this as like a swing day or a trending day. It's basically staying within the range of this low. This high was just slightly penetrated and then back inside the range between the high here and the low here. So we have consolidated. Okay, that doesn't mean it can't be traded or that you can't find setups in it. It just means you have to be much more nimble and you have to be more versed in market symmetry. So because this is going to be a consolidation market, and how did I know it's going to be a consolidation market? On Twitter, I mentioned that we had an old new week opening gap in close proximity to our current new week opening gap. I'm going to save that time and energy in showing you that here on the chart. You can find that on my tweets. So NASDAQ, let's take a look at the business here. this is the Dow in relationship to the NASDAQ. Notice that this market here on the Dow was able to make a higher high, whereas the NASDAQ was unwilling to make that higher high. Now I teach that as SMT. A sixth sister is similar but not the same as SMT. There are conditions with a trending market where the sixth sister opportunity will see a move that hasn't transpired yet on one asset or correlated market, meeting or exceeding an old high or an old low. And I'll explain what I mean by that. Because this high here was taken out by this high on Dow, it would be reasonable to expect in a symmetrical market that the NASDAQ itself would go up there and hit that too. But look closer. What do you see? There's a failure here. So this high is higher than this one, whereas this high is higher. We have a very specific time of day, and we're also looking at this divergence, and we're going to take a look at the ES. The ES was able to make a higher high here as well, but it didn't make that higher high there. Notice that? So if I take this idea and show you on the Dow, we penetrated this high here. Let's add some lipstick to it. So you have the high broken here at 8 a.m. Higher high. Both this high and this high was exceeded with the Dow. On the ES, we made a higher high here, but we did not make the higher high here at 8 o'clock. So this high was lower than this one. If we look at the NASDAQ, we had that lower high across both. This high didn't get penetrated, this high didn't get penetrated, and we're diverging. But now here's where the sixth sister approach occurs and how to use it within a consolidating market. If this one's weak, we're going to wait for this one to drop down into a deep discount. That being this low to this high. Let's run a fib on it. So from this low up to this high, here is your optimal trade entry levels here, and here's equilibrium. So it trades down below it here and then goes into the order block, which is these consecutive down close candles, the black ones, and then we have a fair value gap here. So there's your discount. If you look at this high here and this high here, that's buy side resting here, and I don't need it to go all the way up to here to find a profitable trade. So I can be buying in this fair value gap inside of the order block, below equilibrium, inside of optimal trade entry, these two respective levels here, 62 and 79% on the fib. So I'm going to look to buy in a discount, and you can see that is the case here, right there. And I'll hover over top of it, you can see. Okay, I accumulated the position inside the order block, inside the fair value gap, inside of the deep discount, aiming for the buy side above this high here, and the buy side above here, and I'll put one right between the two of them, here, here, and there. Okay, so that price run here, I did not need it to go up to here, even though it was likely to do so. I got out above here because I knew that once it takes out this buy side, it could want to rejoin what has been seen in the ES and the Dow. Now let's go back to those. At these highs here, at this specific high, look how much more it dropped off on ES and the Dow. So yes, they all three dropped. NASDAQ did not have the ability to get back above this old high, whereas The ES was. The Dow was. The Dow was also able to get above its high here at 230. The previous trading session, ES was not willing to do so. But so one of two highs were taken out on ES. Two of both highs were taken out on the Dow. Neither high was taken out on NASDAQ. That's the sixth sister, and we're in consolidation. So that means it's likely to drop down to a discount and then rally to go back above the buy side, whereas Dow was able to do so. I don't need ES to do so, and it's already went lower anyway. So using the sixth sister in a consolidation market means we're looking for the one that failed to make a higher high or lower low, which is like typical SMT. But the sixth sister approach or concept that I'm using is that it's going to try to do it later on. And you want to put your focus on the weakest one because, well, the Bible says so. First one now shall later be last. First one now shall later be last. This one couldn't even muster up enough momentum to climb higher. Whereas the ES did get a little bit higher, but the NASDAQ ramped all the way back up. First one now shall later be last. This one couldn't even muster up enough momentum to climb higher. Whereas the ES did get a little bit higher, but the NASDAQ ramped all the way back up into the buy side here. So in trending markets, where we'll see opportunities like for instance, say this was a trending market, not consolidation. Whenever I see this divergence here, and the ES and the Dow has made higher highs, but I don't believe it's reversing or even likely to have a meaningful retracement, I would expect this market to resume and go higher. But because the sixth sister approach while in consolidation, which is exactly what I mentioned this morning, because we had the converging new week opening gaps. Whenever you have converging new week opening gaps, they're real close to one another, the market's going to be real likely to consolidate and go sideways. Add to it the economic calendar that we had today, which was anemic. It didn't have any medium or high impact news drivers for today. So we had a lot of factors leaning on this market being, as we see here, consolidation. At 2 o'clock in the afternoon, it did trade back down into an order block, which is here. So at 2 o'clock there, it rallies up and it bumps the buy side there. But notice right above these highs, once it did that, it had a strong drop down, and you have to be careful with that because it can leave that high untouched. It was this high right here is what I was really focusing on and factoring that six sister concept, waiting for a discount. We don't just simply buy in here because it's going up here. I've seen some people reacting to the tweet thinking that they understood me, but they did not understand me. When we're buying, we're trying to buy at a discount. So it had already rallied up. So it needs to drop down, and we see it going down into the opening session, and then you wait for that typical opening range, 30 minutes. But here, when it's dropping down, we're inside that 30-minute range because it's trading into a deep discount. It's inside the fair value gap. It's inside the order block. It's below equilibrium, and it's done a handsome job of getting down into a cheap discount price with PD arrays that are lining up with a potential long to run out the buy side here, and then eventually here in the afternoon of the PM session. I have more to teach about the Six Sister concept. I'll teach you more refined lessons with the Six Sister. It'll have its own presentation, but I just want to kind of give you a review today and draw the parallels and the oppositions to what is classically seen as my SMT. It's similar, but the approach to using the divergences in the later discount or later premium, how you use the information is starkly different. Hopefully you found this one insightful, until I'll talk to you next time. Be safe. Well, welcome back, folks. All right, so we're going to be talking about my ICT Silver Bullet trade setup, which is a time-based algorithmic trading model for all asset classes. All right, before I get into it, let's discuss ticks, points, and pips and the relationship to Forex to futures. For an ICT Silver Bullet trade, the minimum trade framework should be 10 points or 40 ticks for index futures or indices. The minimum trade framework should be 15 pips for Forex pairs for Forex traders. Now, an amplification of that is this. Framework is the best case price delivery that you expect to see, not your actual trade entry to exit range. So in other words, if everything were to be perfect, and you're not trying to be perfect with your entry, you're not trying to be perfect with your exit. If the entirety of the move that you foresee is likely to unfold next in whatever asset class you're trading, that range is the framework. But you're going to be looking for a trade within that framework that doesn't demand you to have the highest degree of entry precision or exit precision. Over time, you'll get better with both of those, entry and exit. But now, using a model, you want to have something that's a little bit more forgiving. So for index futures, if you're trading indices, the minimum framework is it has to at least offer the potential for 10 points or 10 handles, which is equivalent to 40 ticks. The same would be said for Forex. The framework should be a minimum of 15 pips for the pair you're trying to trade. So if you can't work out a range move at least 15 pips, the trade is probably not high probability, and it would be better suited to be left alone and let it pass, or look elsewhere. 10 handles for indices is the same to me as 20 pips in Forex. 5 handles for indices is the same to me as 10 pips in Forex. So many times with my tweets or comments in my videos and whatnot, folks that reach out to me through TradingView, little messaging system they have there. I ignore a majority of everyone that sends me messages at TradingView. I just get too many of them. And the question that keeps popping up recently is, if I'm teaching predominantly presently at the time in 2023 in the YouTube mentorship, which is free, by the way, the question is if I'm looking for 5 handles of price movement in the E-mini S&P, what would that translate for those that are trading Forex? That would be the equivalent of 10 pips. If I'm looking for 10 handles in indices or trading stock index futures, if you're a Forex trader, you would be looking for the equivalent of 20 pips in your Forex pair. So that way there's the relationship between the two. These are essential frameworks to what I deem high probability ICT silver bullet trade setups. All right, so let's talk about, and this is really the gem of this presentation, really, types of ICT silver bullet setups. Now, the framework for many ICT silver bullet setups are as follows, but they're not limited to: previous day high or low draw on liquidity, meaning yesterday's high, if we're bullish, there's going to be buy stops or buy side liquidity resting above that. We would be looking for a run to previous day's high. That expansion is the draw on liquidity for buy side. Vice versa, if we are bearish, we're expecting lower prices throughout the week, and we see the previous day's low as having sell side liquidity or sell stops below it. So we would look for potential setups that would expand down into that liquidity. Previous session highs and lows as draws on liquidity, meaning that, let's say you're sitting down in front of the charts and it's the AM session in New York. You would look at the high and or low of the London session that just passed and look to a run on liquidity or retest of those old lows or highs. Previous weekly high or low as a draw on liquidity. If we're bullish, we would look for a run above the previous week's high, or if we're bearish, we would look for a run below the previous week's low. Another would be returning to a current or old new week opening gap. So that would be treated as a draw on liquidity, or an expansion away from the current or old new week opening gap. And a classic ICT optimal trade entry, which has been for the longest time while doing this YouTube channel, that's always been the classic flagship pattern, but now we've seen many more models and approaches, so it can't be referred to as the flagship pattern anymore. I think the fair value gap has taken the throne there. Confluence of the 2022 ICT Mentorship YouTube model, which I taught for free on this YouTube channel, meaning that your draw on liquidity could be a inefficiency above the marketplace when we're bullish, or a inefficiency below the price when we're bearish, which means that if we're bearish, we could be aiming for a discount, buy side and balance, sell side inefficiency, or some measure of fair value gap that would be below current price action. That would be your draw when bearish. Or if you're bullish, you would be looking for a inefficiency above current price action, which would be many times in the form of a SIBI, or sell side imbalance, buy side inefficiency, or a variant of fair value gap above current price action. So you can treat that, or as I mentioned, all the previous ones above number 7 here, all of them being equally available in terms of probability if it is in the market at the time. Not all of these are going to be a factor. You know, there will be times where the previous week's high has already been rated that morning, and looking at it again may not be the ideal scenario. So it might require you to look at a higher time frame liquidity pool or inefficiency above price if you're bullish. So I could list a myriad of different scenarios, but I think this list is good enough to give the students of my YouTube channel a great deal of latitude, so that way you can look at the potential for any one of these situations. Not all of them will exist. And on any given day, not all of these will be in the charts, but most days, one of these criteria will be in play. Don't take my word for it. Go back through your price action and you'll see what I'm saying here is in fact the truth. Obviously, the main emphasis is determining the next most likely draw in the price action. So where's the price likely to go to next? That's the number one goal for all of my students, is to focus on that skill set first, because all the entries and the accents and such, that is the least important thing, because you don't know where price is trying to go to from the time you're sitting and looking at your charts, and whatever analysis concept you use is probably going to fail you. All right, let's talk about our first ICT silver bullet setup and the time at which it forms. Now, again, this is a time-based model. That means these things are linked to a specific 60-minute interval or window in time. Every single trading day, this pattern will form. It may not be in the Forex pair that you're trading. It may not be in the futures contract that you're trading. It may not be in the asset that you are specifically looking at, but it does form every single day. First setup time is 3 a.m. to 4 a.m. Now, we're always referring to New York local time. So whenever I'm referring to a specific time, whether it be a window of time or a very specific time of the day, you have to have your charts calibrated to New York local time. Wherever that is, whenever that is, in your area. If we're observing daylight savings time, then you observe daylight savings time. So that way it removes all the uncertainty, the confusion, whatever it is in New York, that local time, That's what you're using when you're charting. This is the London Open Silver Bullet. So what we're looking for is a classic ICT fair value gap to form between 3 a.m. and 4 a.m. New York local time. The factor at which you are going to lean heavily on is the skill set of knowing where price is going to go to. Okay, and it's not necessarily the bias. You just predominantly have to consider where the next draw on liquidity is. Is it going to go above the marketplace for buy stops or trade into inefficiency above current price action if you're bullish? In this case, the market was bearish. It was looking to go lower, and there was an obvious sell side liquidity pool resting below that old swing low. And between 3 o'clock and 4, the market created a fair value gap. We had a shift in market structure below this low here. So this is your classic what? Optimal trade entry. Fair value gap here. The market shows the willingness to support this idea with the body staying inside that gap. See that? Now at 4 a.m. it does pump one more time just above it, but that's fine. It would have never stopped you out with the rules I teach with all of my models here, especially the optimal trade entry. The idea for this would be to look for a minimum of, what market is this? It's a futures contract. So that means, does it offer the potential for 10 handles? So from here down to here, trading below this low, not just to the low, but to it and through it. So it's reasonable to anticipate a potential run of 10 handles. We don't require that, but going short inside that fair value gap, the formation of the ICT silver bullet, the entry is taken inside of that 60-minute window between 3 a.m. and 4 a.m. It does not mean that the trade is entered and is exited in the same 60-minute window. In other words, your trade many times will be held over the 4 o'clock hour and into 5 o'clock in the morning, and maybe even rolling over into the New York session opening at 7, 8 o'clock New York local time. But in this instance, we would be aiming for this low and the sell side liquidity resting below it. So does it offer from this entry here down to here at least 5 handles for you to book in profit? It does so. The framework was, could it get to 10? It could do 10. We don't require that. Shorting into fair value gap, covering at the old low, allows for at least 5 handles, and that's what the ICT silver bullet is. This is my actual model for my son Cameron. All right, the second one in our continuing list of ICT silver bullet setups is the AM session. Now this one is focusing on the 10 a.m. to 11 a.m. always New York local time. And let's take a closer look at this one now. Okay, so we are looking at the E-mini S&P once more. And the idea is between 10 a.m. New York local time and 11 a.m. we wait for when the market's bearish. Relative equal lows. There's sell side resting below that. We have a fair value gap, bearish. Fair value gap, it trades up into it between 10 o'clock and 11 o'clock. We can sell short there. Does it offer 10 handles? Well, from 41.46 or thereabouts to 41.36, that range doesn't even get us down into this low, let alone below that one. So it obviously meets the criteria of a minimum of 10 handles. In framework, it does not mean you're trying to get 10 handles. It just means that it offers 10 handles. So going short here, collecting 5 handles, that could have been done inside of the scope of that 60-minute window. Not that you're trying to do that, as I mentioned briefly moments ago. The trade is many times held in duration longer than the window that the framework and entry is derived from. So it's not a in and out within the same hour. It means that you're looking for the setup to form to get you into the trade within the scope of 10 o'clock to 11 o'clock New York local time. All right, and finally we have our last ICT silver bullet here, which is framed on 2 p.m. to 3 p.m. New York local time. And this is the PM session ICT Silver Bullet setup. In this one here, we can see that we traded down into a higher time frame, 15-minute discount fair value gap, and you're encouraged to go into your charts to see that is in fact what we have here. The market trades down into it, shifts higher. A swing has been broken to the upside, so we have a shift in market structure and a fair value gap. So any retracements back down into that, look at the bodies staying inside that, and finally we have our last ICT Silver Bullet here, which is framed on 2 p.m. to 3 p.m. New York local time. And this is the PM session ICT Silver Bullet setup. In this one here, we can see that we traded down into a higher time frame, 15-minute discount fair value gap, and you're encouraged to go into your charts to see that is in fact what we have here. The market trades down into it, shifts higher. A swing has been broken to the upside, so we have a shift in market structure and a fair value gap. So any retracements back down into that, look at the bodies staying inside that. The wicks did the damage, but the body's telling you the narrative. The story is told by the bodies. So it's telling you it's respecting this buy side imbalance, sell side inefficiency, or fair value gap. Going into 2 o'clock, we rallied and we created a small little fair value gap there. The market drops down into that before taking out the relative equal highs, buy side liquidity, and or returning back to a premium sell side imbalance, buy side inefficiency, or fair value gap that would be above the market here and here. So if it's going to rally here, the framework could be on the optimal trade entry here and taking the first fair value gap that forms inside of and reprices to between 2 o'clock and 3 o'clock. That's happening right there. So from here all the way up to here, does that offer 10 handles? Yes, it's actually offering 12 or more. So this entry here is a high probability condition that lends well to a run into inefficiency in the premium and to take buy side out as well. So that is a very handsome run there and trading between 2 o'clock and 3 o'clock. Now some closing thoughts. If you're new to my channel and you're seeing this, you don't have enough to trade this pattern. So you have to back test it while you're learning how to read price action and determine where the next draw on liquidity is going to be for the next price swing for whatever asset class you're trading. So don't be discouraged if it seems like it's just cherry picked and there it is, because I actually traded many of these types of setups either with calling it out on Twitter or mentioning it in passing while actually doing executions and recording it. So these patterns, these things form, and I called a few of them real time on Twitter last week, and many of you, much to my disapproval, because I don't like when you take the setups as a trade setup signal. I don't want you to view it like that, but many of the followers on my Twitter feed actually showed that they took the trade I called out with using a silver bullet. So the pattern works. It's highly, highly consistent. It's extremely high probability when you have all these factors in mind and they are present in price action. It gives you a rule-based idea to look for a time-based model. So time and price is being utilized here, which is where the focus of my analysis concepts and teaching as a mentor, teaching my students how to find something that repeats. You can't get anything better than having a specific 60-minute window of opportunity that forms every single trading day. Every single trading day, one of these setups are going to form. Now, if you don't have a plethora of markets to follow, ideally 1 or 2 at best while you're first learning how to do it. Even if you grow to a point of interest where you have a lot of markets that you're trading, a lot of pairs or a lot of futures markets and such, you'll find that over time, the longer your career will be, your list will reduce down to 1 or 2, at worst maybe 3 if you want to be a deviant. But my advice is for you to be a specialist. Try to focus on one market, because if you can do that, one of these specific ICT silver bullet setups will form every single day. Meaning that if you just follow one market, just one market, you can get your setups there. You can make your bread and butter. You can make your ends meet. You'll have losing trades. Okay, it's going to happen. But by far and large, you can do things with one market. And if you don't get the setup in London, you wait for it in the AM session. If you don't get it there, you wait for it in the PM session. But every single market, every single trading day will offer one of these. So you have to be disciplined. You have to focus and look for these ideas to form in price action. And should you do that, you'll need to look at nothing further than this. You don't need to go into any other models. You don't need to go into any other teachings. You don't even have to come back to my YouTube channel. You'll never have to do any of that stuff anymore, because you'll be independently minded and your analysis will be uniquely yours. You won't have to look at external sources like me or someone else to provide that to you. You'll trust yourself, which is a very empowering state of mind. And that's always been my target and goal with all of my students. So hopefully you found this one insightful, and until I talk to you next time, be safe. All right, folks, welcome back. This is going to be a short little review and kind of like an incorporation of several of the things I've taught in the mentorship in 2022 and in 2023 thus far. So we're looking at a weekly chart of E-mini S&P. This is the delivery contract of June 2023. And I've taken your attention to this area up here. It's also been mentioned in the NASDAQ futures contract. NASDAQ has delivered its respective volume imbalance, which is up in here. So this is the area that I believe that ES, or E-mini S&P, is likely to draw up into. So we have technicals that suggest that we might want to get up there, and I've been talking about that this week in Twitter, mentioning that I favored the run on buy side, and I'm going to tell you why here. We have a discount, fair value gap between this candle's high and this candle's low. This little area in here was delivered twice, and we're consolidating with a weekly imbalance seen here with the volume imbalance. And then buy side here, if it gets extrapolated. We have Powell speaking on Friday at 10 a.m., so be mindful of that. I believe that's the reason why we're seeing the market, kind of like waiting on bated breath to see what the Fed chair would have to say. So they're going to use that as a smokescreen to move price. Also, we have this down close candle again on the weekly chart. The opening price, we're using that. Why am I using the opening price and not the high of the candle? It's because we have a short, stubby little candle wick. So whenever it's like that, in respect to the entirety of its range, I'm going to elect to use the opening price. So we're going to be looking for this weekly candle to expand up, maybe reach up into this high here, and then into the weekly volume imbalance. So tomorrow's Thursday, so we'll be looking for Thursday and Friday's action to try to deliver that very thing and repeat pretty much what we've seen in the NASDAQ. Be mindful of this blue shaded area with the order block. These levels are going to transpose into the daily chart, but don't be confused. So here's that weekly order block level here, and that shaded area, which is the weekly discount fair value gap. I mentioned those two candles trading as wicks on the weekly chart. That's being shown here with the daily candles. I mentioned on Twitter earlier in the week, I gave a short little vignette video talking about how they imbalance here, which is a fair value gap between this candle's high and this candle's low. And that little section of price action is a fair value gap in the form of a buy side imbalance, sell side inefficiency. You can see how the market's pretty much been holding inside of that and reaching up into that premium fair value gap I annotated and showed. And we have relative equal highs back here, which is also residing inside of that weekly volume imbalance. So that white shaded area, specifically 42.44 even. I like that as a draw. It may not get there this week, but I do believe we're probably going to reach up into this high here sometime this week before we close. And whether we stay there and move higher or not, that remains to be seen. But right now, I'm just treating that as a draw on liquidity. So these two levels here, the, I guess, purplish blue color and the pink, those levels are going to be seen going into the lower time frames. We won't see so much of this anymore after this slide. Okay, so we have the buy side liquidity pool up here, that daily premium fair value gap, and the daily discount fair value gap, and the weekly discount fair value gap. So it kind of gives you the ebb and flow of what the market has been doing and why I've been focusing on looking for buy side to be taken. The buy side I outlined on all these highs here. I mentioned this in a tweet saying that they're not really seeing any runs on liquidity, which means that they're stacking that up. So every time we were going lower, 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 the market's going to utilize this liquidity as a means of offset distribution. So what is it offsetting? The longs that were accumulated at that low, that low, that low, that low, that low, and that low. And you may be looking at these lines in here, these dashed and then the dotted line here. What I've done is created the gradient levels of that fair value gap on the daily chart. The midpoint is that dotted red line, and that's consequent encroachment, midpoint. Then the lower 25% and the upper 25%, and then the high and the low respectively of that daily fair value gap. And I'm just going to go up one slide again just to take you back to what I'm looking at. It's this area right in here. So if you do this on your own chart, you'll see what I mean by transposing and watching how the levels are respecting that. This is not quarters theory, okay? Invariably, because I draw rectangles to teach the idea, people have unfortunately quoted me or misrepresented me in a manner where it would be viewed as a reinvention of supply and demand. Supply and demand is not what I trade. The rectangles are just to highlight an area for you to study on your own charts. These gradient levels is not quarters theory. Okay, so go and study quarters theory and come back and you'll see that this is not what this is. But the algorithm will seek these levels in inefficiencies, which is a fair value gap, and it'll use these levels very precisely. And you can see how the market trades here, 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 here. Look at the bodies here, okay? And then the market rallies today up into that premium fair value gap on the daily chart, and it's consolidating. You might want to come back down just a little bit in here, and then I want to see it reprice up into the 4200s. That's what I'm looking for. That's what I want to see. Yes, it's a lot of movement, but you know, we have Fed Chair Powell speaking on Friday, and he can bring a lot of dynamite behind market moves. Okay, so they like to use his words to perpetuate movement. Taking that away and breaking it down to just where it has been, what's it reacting off of, and what's it likely to go to next, that's what I'm seeing right now. So in my mind for tomorrow and on Friday ahead of Powell Chairman discussion, that little fair value gap right there, okay, this candle's low, this candle's high, that's a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. So the market has only offered downside delivery, so to efficiently rebook and balance that area, the market needs to reprice that. So it should see it as a pass on the upside. So efficient price delivery is a pass above and below, or below and above. Okay, so up, down, that's how you reprice and efficiency. Let's go back into this little area here. You can see we have a buy side imbalance, sell side efficiency, which is a fair value gap. You can see we're also respecting that, and also this gap here. So just be mindful of that. I'm not going to keep these specifically on my chart going forward in this lecture, but just have it on yours. Okay, so back into this slide here. We're going to go into greater detail in all of this now. Dropping down into a 15-minute time frame, you can see how the market has respected those gradient levels on that fair value gap. And the way you get this is if you drop a fib and plot it on the high and the low of any fair value gap, or a gap of any kind. Highlight the 50%, the 25%, and the 75%. And you can set that on your fib settings. And then whenever you draw a range from high to low or low to high, these levels would come out respectively. Okay, and I'll teach more about this as we go into the summer months, but right now this is enough to accomplish the method. So we have the market dropping down here at the opening bell, and we're going to go into great detail here and really refine that to a level of precision that is also, by me doing this presentation here, this is how I tell all of my students to go back in old data and back test. This is my back testing. It's not using a Forex tester. It's not using market replay. Okay, that's practicing forward testing before going into live data. It's essential, it has its place, but you need to go back and see and study what price looks like in old price moves and go into the great detail of annotating your charts, which I'm showing you here. So this is an answer to everyone asking, can you show us how to backtest, go into the charts and annotate and journal? This is what I'm showing you here. Each one of these are individual slides that I've created and placed into a PowerPoint. So that way it kind of gives you an idea. I know there's a lot of different ways folks have been journaling, and I'm not going to say one's better than the other because there's so many different variables and options available. So you just do the way you want to do it that is comfortable for you. Okay, so there's lots of applications and apps that you can use. You just do what it is that makes you feel comfortable and go into it as deep and highly detailed as you want. Make it like a therapy, make it like a hobby that allows you to go into old data, study the details, how it delivered, what time it delivered, and by doing that and having sample sets of months and years worth of back testing and studying price action like this, your subconscious retains it. Okay, and because you see it so many times, it's like a pseudo experience, and you want to annotate on the charts in these little areas where there's empty space. You want to kind of like cheerlead yourself and mention in annotations that you saw these things coming before it happened. And by retaining that and seeing it in price action in your own annotations and journaling, reviewing that on the weekend, your subconscious retains that information as real experience. And it's a positive reinforcement because you're never adding anything to your charts that is negative in nature. You don't want to say any complaints about why you didn't expect this, why you didn't do this correctly. Always cheerlead in your annotations. By doing that, it trains your mind to not be fearful of the moves and also recognize things you've seen in the past because of this procedure and process. All right, dropping down into a 5-minute chart here, you can see how the market does in fact put the bodies respecting that consequent encouragement, which is the midpoint of the high and the low of the daily discount fair value gap. Now, I know right away, this is going to go right over the heads of the newer students that just came here. I promise when you start doing this and doing it with your own charts, you'll start to see things that repeat over and over again. This is just conceptually showing you how the market respected these levels and to what degree in terms of precision. Dropping down into a 3-minute chart, which is how I teach my students. We drop down from a 15-minute chart to a 5-minute chart, and then from 5 minutes down to 1, we refine the time frames until we see our imbalances or the model that we're using. I've been recently teaching my ICT Silver Bullet setup. There's a Twitter space that I did. I introduced it, I don't know, maybe a month and a half ago or something, close to 2 months ago, where I outlined it in discussion, like in audio format. There wasn't a video presentation or teaching on my ICT Silver Bullet setup until the video I posted prior to this one here. So whatever video prior to this one, that's the one you can go to and look at and get more detail about this specific time-based algorithmic setup. The morning session Silver Bullet here is the only one I'm going to cover here, but in passing, you can see it up here. This is the PM session. So we have a shift in market structure here. It trades back up into that fair value gap and drops down to attack sell side liquidity there. So for your notes and your study, you can use that as your PM session Silver Bullet. But for here, I mentioned yesterday and the day before that I was interested in seeing higher prices on ES kind of catch up with the NASDAQ. And I specifically sent out a tweet with a chart that noted each buy-side liquidity pool that I felt that the market would reasonably run up into and engage that buy-side. This is a little bit more refined with the details here and using the information I've already talked about throughout the week. We have a buy-side liquidity pool here. The market drops down at 9:30. This is a Judas swing. It trades down and clears out this short-term low here. And this move here, we're going to look at it in great detail also. But we have a shift in market structure right above this short-term swing high right there. Then a fair value gap there. And it occurs between 10 o'clock and 11 o'clock. We're bullish. We've seen the market drop down. And we trade into a fair value gap. This is a silver bullet long. Does buying it here, using this candle's low, buying it here and running to that high, does it offer 10 handles? Yes, because 4140 to 4130 essentially is 10 handles, and that has yet to meet this high here, which would be above 4144. Or so the criteria, looking at that as a silver bullet running to that buy side, it offers a range of potential 10 handles. So you can be a buyer there, and let's see if it gets up there. But you want to take profits at 5, and that's how I teach my son Cameron to work with that model. And it does, in fact, offer it, and then watch what happens once it hits the buy side. It comes right back down in and takes out the sell side. So it's offering what? A run on stops. Why would it want to do that? So smart money can accumulate new longs while trailed stop losses get taken out. But what's it trading back down into? That daily discount fair value gap, but more specifically in the upper quadrant, the 75% of that range. Look closer. This imbalance here, when it trades up here, traders that think that this is a liquidity void or something to that effect, they think that it's done here. It's balanced now. It's not. That's not a balanced price range. That's just rebooked and repriced to an inefficiency. That's all it has done. It has not become balanced yet. When the market trades down to the low of that again here and leaves the range, which it does on this candle here, this has now become a balanced price range because price has been delivered to the downside, to the upside, failed to go lower, respected it, and then left the range. So it's acted as a trading range inside of this one micro imbalance on a 3-minute chart. This candle's high here is the very candle low right there. Precisely. It's not one tick short, not one tick off. It's exactly that price. And I counsel you to look at your own price data and you'll see that is in fact the truth. So when you see that, you can trust that if we start to move higher, then we've probably made the low of the day. And that would be down here. And I'll give you more details as we go, and let's take a closer look at that now. So we're down into a 1-minute chart here, everything being equal. And that balanced price range, you can see the range between 10 a.m. and 11 o'clock, New York local time, always. I want you to take a look at that little area right here on TradingView. At the time of watching real-time price data, generally you're going to have electronic trading hours highlighted, and it would look like this in your TradingView. If you have live data and you paid for that live feed from TradingView, you can toggle from electronic trading hours to regular trading hours and see more detail. So if you click on that, it's going to change it to an option of regular trading hours or electronic trading hours. If you toggle it to regular trading hours, your chart would show this. Okay, and this is what I teach is the opening range gap. Okay, now I taught this to charter members. I taught this to old ICT mentorship students, and this is not something that has been just introduced because other people have talked about it recently. I've been doing this since 1996. So these are things that, you know, they have been there in the marketplace all this time. And while I don't claim the real estate here, you know, as a creator of this, it's just this is one gap I like to see used. Now, if you take this gap, and I'll explain what I mean by that. The closing price, the previous session, and where we open at 9:30, that is the opening range. If there's a gap and we gap higher and we're bullish, this is how you use the information. You expect price to trade down to it, reprice to the gap, and then go higher. Move away from the direction of the gap after it fills. If we are bearish and we see a gap like this, then it could become a trade lower, fill the gap, consolidate, false run, and then break lower. Or if we're in consolidation and we have already met some higher time frame weekly objective and we have a gap higher like that, then what can happen is once the gap fills, nothing happens. It just uses this entire gap throughout the day. but because we've been bullish, as I highlighted yesterday, it's a gap higher opening, fills and reprices down into that opening range gap low, which is where the session closes on regular trading hours the previous day. You can always find that price by simply just toggling the electronic trading hours to regular trading hours. This is why the RTH is down here. You'll see that separation here. So what's hiding is all the electronic trading from where it traded yesterday at settlement to where we opened at 9:30 opening bell in New York local time in New York. So that difference there is going to be sometimes shown as a gap. It could be a gap higher like we see here, or a gap lower, or it could be unchanged. We would like to see a gap of some kind because a gap always creates an inefficiency, and inefficiencies are many times, not always, many times repriced too. And how we use that information is paramount going forward. What I teach, this is something that's unique to me. This gap, once it's completely repriced, then if we're bullish, we can take that gap and do multiplications of that and project it higher. So if you take that range from the low to the high and you multiply it up, you can get 2 standard deviations, which essentially gets us real close to the high without even needing that premium fair value gap that's in the pink area. Okay, but look at the respective of that premium fair value gap I've highlighted. I mentioned this again on Twitter beforehand in tweets. So just go back and look at this stuff I put up. I didn't put very many tweets up this week. Go back and look at them in a little short vignette that I talk about, for imbalances and where everything is, trading and such. And then look at it on your charts. So in terms of my Power 3, the daily range was shown at the opening at 9:30. It trades down, which is a Judas swing. Traders that are retail traders, they'll chase that move going lower because they're not aware of that inefficiency between regular trading hours and how the electronic trading hours are hidden when you look at a chart like this. There was trading, but now we're met with an opening range at 9:30. So that opening bell, which is all the volatility that initially comes in the marketplace, is usually this type of function where it seeks to reprice to the previous session's close. So we see that here. It drops down, creates the low of the day, and then starts to trade higher. As soon as we meaningfully move above the opening price here on this type of day, which would be really essentially swinging above this, then the market does what? It really starts to run higher for a premium. What premium? The premium fair value gap that's shaded in pink. Watch the beginning of the video. I take your attention from higher time frame down, so that way you can keep track of what I'm looking at and how it's salient. So essentially what we're looking at here is my Power 3 concepts, which is the open, manipulation, accumulation of longs, distribution into a premium, and then settle at the day, close. So Power 3 is being shown here. The daily range is a classic ICT buy day. The Judas swing to reprice the opening range gap low, which is down here. Also a daily fair value gap consequent encroachment confluence. That means that the midpoint of that daily discount fair value gap, which is here, it trades down into that. Additional credit, if you want to go into your new day opening gap, and I did a video presentation about that on this YouTube channel just a few videos back. Go watch that, and you'll see how you can use the new day opening gap also as a confluence of this low as well. So many factors of why it went down here. A trader that uses retail logic would not be able to see all these confluences that I'm showing you here. And then a draw to buy side liquidity that was shown in Twitter on May 16th, which was yesterday of 2023. And then the high of the day was booked at the daily premium fair value gap high. And when you have all those details over here, there's your high, there's your low, all these details coming in together, making a beautiful tapestry of how the algorithm itself prices, reprices, redelivers, balances, and then seeks new liquidity. That is essentially what you're doing when you're trading with my concepts. You're seeking what the algorithm's likely to do, move higher or lower. Why should it go higher? For an inefficiency, or to take out buy stops. If it's trying to move lower, why is it going down lower? It's going down to trade to an inefficiency or take out sell stops. If it's not going to do either one of those, it's going to consolidate and range bound and frustrate traders, which is what we've been basically seeing for a number of days now, and weeks really, if you want to be dogmatic about it. So there's a lot of detail in a back testing procedure. Okay, and you go through and you use all these little areas over here and you fill in your observations. And you want to kind of like cheerlead yourself and talk about look how the market respected this silver bullet, which is a fair value gap on a 3-minute chart, but we're watching a 1-minute chart now. So all those things that was annotated on the 3-minute chart was transposed to this 1-minute chart. You want to include everything that you see and observe. Everything. And that way you'll have more detail in your journal instead of just showing some charts and maybe a scribble here and a scribble there of useless information. You really want to make this kind of like a meditation. And yes, it takes a lot of time. Yes, it takes a lot of work and effort to be organized, to have your charts mean something to you. What you're doing is you're writing the most important, useful trading manual that you'll ever read. And you're doing it with your own eyes, your own experience, your own annotations, your own charting, your own snapshots of each individual chart and each individual respective time frame. There's no better trading book or journal or instructional manual on price action than what you're going to be creating by doing this. And that's why it takes time, months. Okay, and the more work and effort you put into it, the better you're going to be at reading price actions. This is the secret part of the recipe here. Every one of my profitable students did these types of things. They went back and looked at old moves. They studied them. They looked at them and they looked at all the details, what time certain things occurred, what time did it reprice to the high or low of the day, and study that from a higher time frame, sticking with a bias, looking at, why should a price move run to a higher low? Why should it move higher? Why should it move lower? And sticking with that narrative. And then going through your charts with that mindset and looking at all the opportunities that presented itself over time, you will have a rich tapestry of reading price action in old hindsight moves that is going to be applicable to future price action that you'll watch live. Every technical study, endeavor, doctors, technicians, every one of them individuals that go to work now with their practice or their profession, they all practiced in case studies that were hindsight. They were already done. And I mention this analogy a lot all the time too. Even surgeons worked on and cut on cadavers. So a cadaver is a body that's been dead and it's been offered to the Department of Science. So that way people that are training in medicine can do operations, surgeries, and study the anatomy of a dead corpse, just a dead person. That will never be able to be reanimated. So there is no chance of harm. The worst that already has happened, that person has expired, they're dead. So when you're trading with hindsight, when you're trading with a experience in annotations, you can't lose. It's all upside. But the only real, I guess, downside would be is to not take advantage of doing it and or record negative affirmations in your annotations. Like, I was stupid, I missed this, or I did this or that and this doesn't work. Every time when I try, this doesn't pan out the way I want it to. You don't want to do that in your annotations. What you're doing is you're cheerleading yourself. And that way, when you read your journal entries, they'll be in your own words. You'll be pulling out information that you have found in old price moves. And then you map out each individual day, just like I did. And by doing that every single day, this is the reason why I teach you to have one market or two if it's closely correlated, but nothing more than that. Because you want to have as much time and energy placed on studying one instrument, one market, one pair if it's Forex, one market if it's a futures contract. And dig into that and do really, really rich, detailed study. Because the same things I'm showing you here exists in Forex. It works in Forex, it works in commodities, it works in futures. So it isn't like this only works here and there. All these principles are applicable to every asset. So with that, until I talk to you next time, be safe. Just buying it here using this candle's low, if you have live data and are hidden when you look at a chart like this. All right, folks, welcome back. Just a quick little review on post-analysis. Yesterday evening, I gave you a breakdown and review of E-mini S&P, and I told you what we would expect to see going into Thursday and Friday. And this is the chart that I showed you last night. Don't take my word for it. Look at the previous recording. I can't edit it. It's already uploaded on YouTube. It's time and date stamped. This is the levels here. I mentioned how we would draw above for the buy side here and draw into this old weekly imbalance. This is what we saw today. This is a weekly candlestick. So you can see the weekly chart did in fact expand in the direction I was expecting. We did get the buy side above the high here, and we did trade inside this volume imbalance. For the folks that are asking and mentioning and kind of like talking amongst themselves in Twitter, why am I not using the continuous contract on TradingView? Well, the continuous contract is not going to show you the inefficiencies that the actual individual delivery contract months will. For instance, if we get above this high here, I like this SIBI and I also like this volume imbalance. So it depends on how much continuation we have in price action, but we take one step at a time. So the benefit of having a thinly traded contract, because this contract was trading well before it became the front month. Right now we're trading the June contract. Well, this is the June contract shown in a weekly chart. If I show a continuous chart and then compress it into a weekly candlestick chart, the inefficiencies won't be so obvious. So this is one of the built-in advantages of having a time-based chart. There's a lot of people out there that will claim that time-based charts are useless and you have to have some other form of analysis or some kind of other bar or something to that effect. That's nonsense. You have no idea what you're talking about when you say that. Time-based charts is exactly the root of why price is going to go where it's going to go, because the algorithm runs on time first. It's time and price theory. All right, and here is the daily chart I showed yesterday evening. So here's yesterday's chart. All I did was use the same slide that I created yesterday evening, and now here's what we're going to see today. There's the delivery to the buy side I told you we would see, and we drew into that weekly volume imbalance. Not hard, is it? Not complicated. I'm not trying to bring in every ICT concept I've ever created into one single model. I'm looking for a simple idea. Where's it going to draw to next? I outlined it. I showed you why. I built it from a weekly chart to a daily chart to an hourly chart to a 15-minute chart to a 5-minute chart and a 1-minute chart. I can't make it any easier than this, okay? All you're looking for initially while you're trying to learn under my wing, you're looking for the skill set of knowing where price is going to draw to next. Okay, it's going to go higher, it's going to go lower. I am lending you my experience as a mentor So that way you can study price action with that in mind. It's not that we're trying to create challenges for you to never succeed at. I'm telling you, this is where the bulk of your work should lie in the beginning. It's not looking for entry patterns. It's not looking for the new ICT gadget or concept. You want to be focusing on journaling, going back through old data, and finding these repeating phenomena that I'm teaching you, because once you see it, you can't unsee it. Once you learn it, it can't be unlearned. Then you'll be initiated. That's the cult of winning we have around here. Okay, everybody likes to say we're a cult, and I've gladly accepted that, and we're the cult of winning. You can see here again, no hindsight. Okay, I can't manipulate daily and weekly candlesticks when I told you beforehand what to expect, and here we have it. So let's take a closer look at what we saw this week. So here's the price action as I mentioned last night. Only thing I did, take off the gradients in here, and these little arrows, don't be fooled by that. Okay, all I'm showing you is the key turning points. So when you're doing your journaling and you're logging all of your price data and looking at old moves, you want to be putting arrows there because it trains your eye to see it just like that. And then when you start practicing your executions in the future, not now, you'll see that you'll be entering at these types of levels and with a logic behind it. So last night I took you to this fair value gap here. I said we would draw up into that, and then the buy side and the weekly volume imbalance, so that shaded white area up here. Okay. I also mentioned to go back and watch that video. I said while we were consolidating here, we would likely, because we didn't do this run up here yet, this was all midnight. We were trading in this little area here. I said we were likely draw down into this buy side imbalance, then go higher. We did that very thing here. If it drops just inside of that imbalance, and we're expecting a shallow drop, that run is going to be initialized by a institutional order flow entry drill. And that's a tongue twister. That's why I labeled it an IOFED, just an abbreviation of institutional order flow entry drill. It's a partial entry to a fair value gap, whether it be a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. So either or, and since we have an up close candle here, that makes this a BISI, buy side imbalance, sell side inefficiency. All of the things I just mentioned are by category of a PD array is a fair value gap. But a fair value gap can be broken down into different classifications. This being a buy side imbalance, sell side inefficiency, because it's going higher, it's offered buy side. It's imbalanced because it only offers buy side. It's one single candle doing it, so it's inefficient in the sense that it's not offered any sell side. But if the market's bullish, as I've been indicating to you that it is, it's going to go down into this area here and keep some of that open. So we did that very thing here. We dropped down into that candle's low just a little bit, and then rallied up, created another buy side imbalance, sell side inefficiency with this candle here. This candle's high, that candle's low, frames this as a buy side imbalance, sell side inefficiency. We also have a breaker here. So the market trades down into that. Also, consequent encroachment of this gap. This is a daily fair value gap. This was the daily discount fair value gap. Remember the two areas here on the daily chart. Go back and watch last night's video. You'll get better insights by doing that all over again. And I promise you, it's not a long video. You're welcome to speed it up at 2 times the speed. But the price goes down into consequent encroachment, which is the classic optimal trade entry that I've taught many years on this channel. But it's coming back in to touch and reprice this candle's high. So once it hits that, then it's permitted to leave that range. Once it trades above this high, this becomes a balanced price range. So we can trust that it's going to go higher. Higher where? To the buy side here, and then dig into that weekly volume imbalance, which is what we see it did here. Dropping down into a 15-minute candlestick chart, you can see that we had that institutional order flow entry drill. It drops down here during the morning session. This is a Judas swing. It rallies up. What is a Judas swing? It's a fake move. Okay, so it rallies up, creates a 3-drive pattern. I did 2 trades in here. I shared that on Twitter just because people ask all the time, did you do anything? So I did. And then the market went down, dropped into a fair value gap here, and then rallied up. And then I chose to engage the afternoon session, which was a silver bullet trade for the PM session. And Let's take a closer look at that morning session first. So we have the 3 drives pattern here. 1, 2, 3. Institutional order flow entry drill down here. After taking sell side out, it rallies. Then we have the short-term reversal pattern here. This is a classic price action pattern. It's really good to indicate that we're likely to see some measure of retracement. It can be an all-out reversal, but because we have unfinished business, which is that weekly imbalance up here, that weekly volume imbalance specifically, NASDAQ has done outstandingly on the upside. As I mentioned, I've been coaching along with NASDAQ being the leader of the upside, and it would draw ES up higher in sympathy. So this is a 6 sister concept. I'm trading the pair that has lagged. Okay, I did trade in NASDAQ today also. You can take a look at that on Twitter. I showed the examples and executions there. But I wanted to teach you using the 6 sister concept because I kind of the flavor of the month, ICT flavor of the month concept, using this idea that it will want to catch up to what the NASDAQ has done. And we see that here really moving to an upside run into that weekly volume imbalance with an extrapolation that was just really, really nice to be a part of this afternoon. We have a breaker here. So we have high, low, higher, high, send that through. That's this little retracement here. It broke down just to clear up the sell side here. Then we entered into the New York PM session, which is 2 o'clock to 4. And then we had some fair value gaps and such. And then the final hour market on close macro that I've been teaching vaguely, which will be taught in great detail in my books that are coming out. And everyone that keeps asking on Twitter, when is my first book going to be released? I set a challenge for all of you as a community. Once I got to 1 million subscribers on YouTube, I would release book 1 of 4. 3 of the books are technical in their algorithmic theory, my concepts. And then the 4th one is a fiction. Okay, it's not essential reading, but it is what it is, right? So I have other things I'll teach you throughout the year. Some things I'm going to hold off for the book because there's a lot of people out there taking my concepts and hurry up and rushing them into their own little books, and they're incomplete. And I'm offended by that because you're trying to get something out ahead of me when you have it incomplete. And that's why I'm holding it back, because once I put it in print, then it's going to be hard for you to run around and pretend you created it or found it on your own. So here we have a closer look on the 1 minute chart. Imbalance refined into that fair value gap here. It drops down in, clearing up relative equal lows here. Before we get to that, let's look at the 3 drives pattern. We have consequent encroachment of this imbalance, runs above this short-term high. You watch me do a execution on partials here. I took a long on a fair value gap, took partials here, rolled the stop to better than break even, came back, hit my stop, and then once more I went back in and went long once more above the highs. I took partials, rolled my stop to better than break even, and it came down and stopped me one more time. I was trying to position myself because I was going to be away from the charts throughout the afternoon. I was with my wife and driving in a car and riding in a car, and I can't be in front of my desk. So I'm looking at everything through my phone only, which is something you don't want to do. But for practice sake and giving you all examples on Twitter to follow along, that's the best I could do today. And the market broke down. We had the breaker here. Really nice run to that breaker and fair value gap right there. That right there. This, folks, right here. This thing right here. That is a complete model. We have a higher structured, not that it's higher time frame, but a higher structured breaker. Okay, a breaker is a low that has a high to the left of it and a higher high to the right of it. Okay, so it's high, low, higher high. Once this low is broken, it is here. We have an imbalance. That little imbalance right there, that fair value gap that's not highlighted, it's trading up into that and then hitting the breaker. This is also an optimal trade entry. It's also trading into a what? Bear shorter block, which is a closed candle prior to this movement lower. And then look at the delivery here. Boom, speed right down to that old imbalance. Then creates a consolidation. Is that surprising? No. What time of the day is it? It's New York lunch. So what is it doing? It's creating relative equal lows, and then it rallies. What is that going to entice traders to think? That's support. So any long holders, they're going to chase that. They're going to run it up into the breaker one more time, which is mean threshold, middle of this down close candle right here, the big beefy longer bodied candle, midpoint of that, and then shifts it lower, attacks the sell side, which is the classic run on New York lunch. It's a stop hunt. That's the macro for the lunch hour. There's a lot of people out there saying there's no lunch. Nobody's going to lunch, during lunchtime. Okay, these people don't know what they're talking about because the algorithm is going to reprice to those stops, and it's using time. What basis is it? It's the New York lunch hour. Look at time, 2:15, 1 o'clock. So in that 1 hour period between noon and 1 p.m. New York local time, we have now classic enticement for retail traders to see that as support. So that level right there is going to have a lot of sell side liquidity, and the market runs from the breaker down into that, hits it, and trades into the imbalance right here, which is institutional order flow entry drill as well. And this is also a fair value gap. This nice little retrace. Into that, and then delivers harshly right into that fair value gap. Moving into the afternoon, we can see that turn here. We rally up, consolidate, and then starts to rip higher, attacking what? The buy side here, and then the old buy side liquidity pool, and then the weekly volume imbalance. So it's very quick run inside of the PM session, which is 2 o'clock to 4 p.m. New York local time. This is your PM session silver bullet. You get 2 chances here. 1, 2 rallies, and then the final market on close macro, which is the last, it's 3:15 to 3:45. In that window, you'll get another opportunity to set up a run for liquidity that has not been managed or engaged for that particular day, where the market fills the numbers. And by market on window, you'll get another opportunity to set up a run for liquidity that has not been managed or engaged for that particular day, where the market fills the numbers, and it runs up, hits the buy side, hits the weekly volume imbalance as well, and just beautiful delivery. All right, you can see again, here's that silver bullet, which is between 2 o'clock and 3 o'clock. So between 2 o'clock and 3, there's the silver bullet. One more little extra opportunity that's post 3 o'clock, but still using that setup here. So it's being reclaimed at fair value gap right there, and then it rallies up, trades back down in. Look real close. You see this inefficiency here in that candle's high? How price runs through this shaded area. All of this area here gets repriced to. See that? That candle's low. Trade up into it here, a little bit higher, and then trades back down. It stops right there. Why is it stopping right there? Well, it only needs to go down to this fair value gap right there. And we already traded up. Once this candle went down, the next candle opened, traded up here. So this to this is only inefficient. So it needs to only go to that level. Then it can rally and run to the buy side liquidity pools I mentioned last night. This is the power 3. This is what the daily candlestick looked like. From 9:30 open, small little movement lower, rallied up, creating the high of the day. I'll get into that high of the day in a second. And then closing here. So we have another classic buy day. Open, decline, Judas swing, rallies up, closes on the high. Working that fair value gap. The 9:30 open was essentially near the low of that shaded fair value gap. Here is the opening range gap, which is the regular trading hours. You can see that difference between where we closed previous day and where we open at 9:30, that little shaded area. I hinted at something that we'll talk more about in the book, because these types of things are just too good. They're just too good for YouTube. There's too many yahoos out there trying to take my concepts, okay, make mentorships off of it. No credit to me. You know, I'm not gonna lay my best stuff out here. I will put it in print. That way you'll see it, and it's mine, and everybody will know that it came from me, because there's too many people still out there pretending that they found this on their own, or it's some dead guy that never talked about it, okay, and I stole it or rebranded it from them, which is nonsense. But I talked about how you can take this imbalance and multiply that out and project it up, much like I taught with my central bank dealers range, and much like I taught with flout, and how I amplified what everybody that was aware of the Asian range for a long time. I supercharged that and taught you how to use it and make it better. Okay, and I taught you in terms of standard deviations. But you can do that opening range gap the same way, and you can do projections higher. And then we have an overlap of negative 11 standard deviations, and price comes in at 4214.75, which is the basis of why I took my exit right at that low, which would be just a hair below this level here, and 4214.75 looks like this, and we went just above it to trade into the 4215s. That was the high of the day. I'll counsel you to go look at Twitter. You can see my executions and such on the PM session for ES and NASDAQ. Market on close macro. All of this business in here was all discussed as it pertains to the PM session silver bullet and the final 15 minutes after 3 to 45 minutes after 3, that 30-minute window, that is a market on close macro. The algorithm generally will run for liquidity. Now, if the liquidity has been tapped, that means a higher time frame liquidity pool or target's been met, then it usually won't spool and start running. There's no need for it to do anything. Then if it's done that, the last 15 minutes of trading between 3:45 and 4 o'clock, you'll get some kind of little sputter move, which is, maybe it's good for 5 or 8, maybe 10 handles, maybe, but not terribly explosive. But like this, I told you last night what to expect. We were going to look for 4206. We were going to look for a 15-minute premium fair value gap, and we'd look for it to draw up into that weekly volume imbalances, that shaded area, and it delivered like gangbusters. So this is what we have here today, and hopefully you can take this information and start to see that none of this is random. None of it is conjecture. It's a logic as to why price is moving the way it's behaving and the time it's expected to do so. It's a wonderful approach to trading where you don't have to rely on any kind of indicators. You're dressing your chart up. You're trying to stay organized. You're trying to anticipate, not react. You're trying to anticipate what price is likely to do next. It starts with a draw on liquidity. Draw on liquidity is just basically where's it going to go to next. Because if you don't have that information, if you have not determined that or have the skill set to be able to determine that consistently, you're not going to be profitable. I don't care what method you use. You have to try to see where price is needing to go to next. Who benefits the most? If smart money benefits by price going higher, you can look for retail traders to get punished. What would that look like? Relative equal lows. Retail sees that as what? That's classic support to them, right? They take it down to take those stops. Why would those sell stops be advantageous to be liquidated? Because smart money will buy those sell stops. They'll be the counterparty to that sell stop being activated. They're buying that. So they're going long there, where longs have placed orders to go long here based on this pseudo support. No. Price allows smart money to be the counterparty to those sell stops being engaged. So when those sell stops get tripped, there's a flood, a rush of selling orders in the marketplace, which is beautiful for smart money to accumulate that and be buying at a cheaper, low price. Then it rallies and it attacks what? The buy stops above here. Who would have buy stops above that? The people that were momentarily lucky, didn't take profits. They don't take partials. They don't take profits. They don't have to get out of the marketplace at the right time. Their stops is resting right above here in the form of a buy stop. Why would it be advantageous to trade there or above this level here or up into this weekly volume imbalance? Because smart money will look to distribute their longs there. So offset distribution occurs with smart money buying the sell stops, selling some above this high, selling some above here, and above here. And they liquidate that. And that liquidation of their longs above here, they're selling above here, which gives what? The retail traders the liquidity to be a buyer of when they're chasing price. When it breaks out here, who wants to buy that? Breakout artists and the smart money selling their portion that they went long down here to there, which is why I'm teaching and teach my students to sell long positions partially above old highs and to cover short positions below old lows. That's what smart money does. It does not follow retail patterns. It does not look at moving averages. It does not look at breakout strategies. It doesn't do that, okay? They don't do that. The algorithm will set up scenarios where retail traders with that mindset will fall victim to it. And you don't want to be in that category. You don't want to be a classified neophyte forever in trading with retail logic, never coming to the understanding of what these markets are actually trying to do and how they book. So hopefully you found this one insightful. Until I talk to you next time, be safe. All right, so I'm going to be doing a silver bullet short this morning. I'm going to be noting the sell side here. And then we'll change the color here after. Okay, and I'm going to set a rectangle inside this here. I'm watching this one. This might present the silver bullet for this morning, aiming for that sell side. I really like the idea of returning back to the current new week opening gap high and consequent encouragement. It's just the midpoint of that. Okay, then change this color. Alright, and I think what I'll do is I'll use a limit order just above. Yeah. Alright, so I got 6 as a limit order, and for now I'll just put the stop loss right above fair value gap, targeting the sell side here. I'll manage this as I go. I want to see if I can build my typical 10 contracts into this. I want to limit entry, not just marketing enter. I'll change this to 4, and just a little bit below that we'll try to use a entry there. So that will be 10 contracts short if it goes up inside that fair value gap. Now the only thing that concerns me is because we have that large range up close candle to the left of all of this decline, and the fair value gap I have noted here, that might become a balanced price range, and it may not even enter back into that. So I'll have to wait for a subsequent or later fair value gap. I've run the risk of missing the move, but it's better to miss the move than to try to chase it. So admittedly, I'd like to short it right in here, but my stop would be at 42.12. So it's a little bit more points drawdown than I'd want to suffer. So I'm going to let it go here. Hopefully it goes up and hits the limit order, and then I can work towards that limit order at 42.03. I suspect it's going to go lower than that, but I have to see how it trades in here. If it trades below 42.03, then I'll just cancel the entire trade. It would be too far down for me to consider that fair value gap. So we're technically inside of my ICT Silver Bullet time window. So we're 2 minutes, 3 minutes almost after 10. And we have just now tapped into that low that was a draw on liquidity for me. So I'm looking at that. I'm wondering, do we get a shallow drop just below it, maybe 1 or 2 ticks, and then leave that shaded area intact? Because I think we'll try to dip below that 42.01 level. This is how it is sometimes, folks. It might run without you, but I'm going to give it the benefit of the doubt in here. If this candle can close and leave that previous down candle, these are all 1 minute candles now. If it can create a fair value gap in there, then I'll adjust that rectangle down to that, and that would be my silver bullet. Expecting the one that I have shaded now as a silver bullet as a breakaway gap. In other words, not seeing it trade back up into it. I think that's what I'm going to do here. I'm going to drop this here and here. So it's kind of like an evolving silver bullet. So I think that initial range up there, let me get these off here and adjust this just below here for now. And now I'll take you visually into what I'm looking at. So that right there is the low, and this is the high of the new adjusted silver bullet. So it's evolved from what I thought initially was around that 42.10 level. Now if it can trade to 42.06 and a quarter, and note that shallow run under. See how it just went like 1 tick below the low I was aiming for. So now I'm really feeling confident that we're going to go up and hit that new adjusted and evolving ICT silver bullet, and I want to go trade back down into the new week opening gap high. And actually, I don't really want to do that. I want to do a layering. I think we're going to go below new week opening gap high. I'm going to reduce the stop because if it fills it, it shouldn't go up there. Trying to think how I want to. Okay, well, we just got to fill. So all 10 contracts are now short. Stops at 42.08 and a quarter. Let me get this off here. Then what I'm looking at is how I want to do my exit. I want to see if we can drop in here, which is what I want to see. I want to see it like run quickly away from that gap. That would be, in my opinion, confirmation that I'm on one side, I'm in line with institutional order flow, and it will want to reprice down into my new week opening gap high and maybe consequent encouragement. But I want to try to take the bulk of the move off, so I'm going to cancel this here, and I'll do some layering with some limit orders. So I'm going to click on there, buy limit. So I'll take 4 off just below the new week opening gap high. So far, price is looking strong for me here. Weak in the sense it's going lower, but strong in the idea that my trade's short. So I get a measurement here for consequent encroachment so you can follow along. So 4193.5. We can work with that. I'll take 4 off there. So that remains a balance of 2. I got to change that 4 to 2. And I'll take it just about 75% of the new week opening gap range. So there's 4, 2, and 4. So if this puppy runs, I'm locked in with a really respectable amount of profit if it can hit it with relative low risk. So we'll just sit here and watch the price action. I'm just removing the fib here, so that way everything's clean now. We can all watch whether I'm right or wrong, which is irrelevant, but this is the price action. I want to see it really just wipe out that low, that little shaded area. That is the difference between Friday's price and where we closed and where we opened this morning in here. So I want to see it work really aggressively below and really draw right back into that current new week opening gap high. And then it should, if everything is accurate in my observation, we should see it really sink lower and attack that consequent encroachment 4193.5. I run the risk of it going completely into, one second, stop here. As we take our first profit. Oh, look at that. Second profit filled. And let me get this out of the way so you can see the 4 remaining contracts. And there we go. Nice. Got a triple. So that's what a evolving silver bullet trade looks like, and using new week opening gap. Can you guys hear me? Can you hear me talking? Hello? Just want to make sure you can hear me. Just give me an audio check 5x5 if you can hear me. Testing 1 2 3. Testing 1 2 3. Is the volume level good? Can you hear me? Can you hear me? Can you hear me? I'm checking Twitter to see if you can hear me. Is the volume good? Very, very good. Thank you so much. All right, so take a look at this risk disclaimer. It's probably been showing for a few minutes for you. Very important. This thing has gave me a fit tonight. Somebody doesn't want you hearing this. So, you know me, OCD. So here is the economic calendar. So just real quick, take a look at this. I'm not going to go through it and waste your time. But everything here is important for tomorrow's trading. Cable traders, be mindful that 2 a.m. you have CPI number coming out, so you could have a nice volatile London session there. And then we have FOMC minutes and Yellen speaking tomorrow, so it's a little bit of a wonky Wednesday. And on Thursday, we have 8:30 news embargo lifting with preliminary GDP and unemployment claims and home sales at 10 o'clock on Thursday. And then Friday we have price index and then durable goods and consumer sentiment at 10 o'clock. So Friday will probably be very eventful as well. All right, so I'm going to try to go through this. I wanted to cover cable, but because of all the technical issues I had with OBS and then going through the process of creating the charts and such, I was trying to make it so I would stay right on point. When I do PowerPoint, it usually helps me stay on task because it's very easy for me to stray and go down rabbit trails and have like additional content that I think is pertinent. But a lot of the newer viewers don't appreciate that because their attention span's too narrow because they don't really appreciate what it is I'm sharing. So I don't have cable in tonight. I have dollar index, euro, and SPOOS. SPOOS is ES or E-mini S&P. So we're going to cover that in a lot of detail. I promise you're going to learn some things tonight, and we'll talk a little bit about order blocks. Okay, and you'll see there's a vast difference between what everybody else thinks they understand about my order block theory versus supply and demand, which it is not. But let's get right into it. Here's the dollar index, is the weekly chart. And I'm watching this candle right here. Now, usually I'll have a highlighted cursor, but you're just going to have to work with me here tonight, okay? We're doing, sounds like my dogs are tearing the place up upstairs. Bearish order block. Everything in this video is rough cut. Okay, so these are things that I would usually edit out, but we're going to have to work through it, won't we? So this up close candle here, that opening price, I'm extending that to the right. Do that on your weekly chart, and you'll have the level I believe is likely to see dollar index draw up into. We've had this imbalance here, and we've passed through it twice, and I'm thinking it might lend support now. So it's an inversion fair value gap. That's how I'm treating it. And you'll see this orange shaded area transposed in the lower time frame charts as we go through. And on a discount, I'm looking at these two levels here. We have the weekly low of this current week, and then 2 weeks ago, that high. So that's a discount. So I'm anticipating and expecting price to want to gravitate towards this candle's opening price, which is the bearish order block on the weekly chart. Okay, so don't get lost in the dialogue without making sure you understand what chart I'm showing up here in the upper left-hand corner. It's a weekly chart. So these levels will transpose when we go into the daily chart. And here we have on the daily chart, the dollar index. Here is that weekly order block level. And then we have a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. And then here's that weekly orange level I told you about. That's the one I'm treating it as a potential inversion fair value gap. And a discount, should this reject and go lower, the last line in the sand for me, for the bulls, for institutional order flow to remain bullish, it needs to stay above the halfway point of this down close candle right here, which is a bullish order block. So on your chart, I didn't add it here because it's already got too many lines on it for my personal taste, but I have to give you the levels I'm looking at. Otherwise, you'll not know what it is I'm anticipating or referring to in price action going forward for the rest of the week. So halfway through here is mean threshold. So draw that out on your chart. The way you get that is drop a fib on this down close candle from the high to the low, the 50% level, note that price, and extend that forward going into the rest of the week. Okay, and if we don't go to this level here or break below this week, keep that level also into next week, okay? Because that's my last line of defense for institutional order flow to remain bullish. Everything has been bullish thus far, so I'm expecting it to go here. I don't suspect, but it could, I don't suspect it's going to trade above this fair value gap here. And if you look at this pass through here, this one up close candle, and then this down close candle, that range between the two of them, that's what I refer to as a balanced price range. That's why I'm saying I don't believe it's going to go above that. If it does, then we're really extremely bullish on dollar, which it doesn't make any sense to do that right now. But, you know, stranger things have happened in the last 3 years, haven't they? So I'm electing to use the weekly order block as my draw on liquidity for dollar. So we have a risk off scenario until this fails. And it definitively fails when it goes through the midpoint of that down close candle. Okay, so these levels being as they are here, they will be transposed on the lower time frame. I'm not using the lower time frames for dollar because it's not necessary. You can use those same levels and check them out on your charts. And just getting right to the meat of the presentation tonight, here's the euro dollar, again, weekly chart up here. I was watching this volume imbalance and I was wanting to see if it can gravitate towards that. It failed to do so, and we moved lower. So I'm treating this down close candle here as a bullish order block. I believe that's the draw on liquidity. There is no inefficiency in here. So I'm thinking that we could come down here and touch that candle's high and or opening price specifically is what I'm aiming for. And that's what I have noted. On the daily chart for euro dollar, you can see we had that run up into the last up close candle here. That is a bearish order block. It's traded into the weekly volume imbalance once there, but didn't get up into that area here, but we did take out this high. This is another reason why I have not been really interested in Forex, because this type of price action to me is really boring. Now, if you go into a 1 minute, 15-second chart, you can take all kinds of really, really small micro structure types of trades. I'm not saying it's not tradable. I'm just saying ICT doesn't want to trade it. Okay, so I'm not interested in this. I want to see much better inefficiencies to work with, better depiction of buy side or sell side liquidity pools. These are all just really back and forth price movement. And to me, I don't like that. There's better markets to trade. And if it doesn't offer me a market to trade that's better than this, then I'll take vacations like you see me do in the recent 2 months. And when I'm able to see it cleaner, I can call it and tell it and show it to you, and you can see the executions. But when it is performing like this, I'm not interested in it. So there's other pairs that you can trade. You can use, the crosses. You can use the pound dollar, Aussie dollar, those types of markets. And if we have that high impact news event for GBP tonight, which would be 2 o'clock in the morning my time, for the folks across the pond, it's your morning, that, in my opinion, you'll have a lot of volatility going into tomorrow. So if you're up and you're able to trade London or paper trade it or demo trade it or tape read it, I think you'll have a pretty good session to do so tonight. But I'm sticking with euro because, I want to keep things simple. Drawing down into that 107 big figure is the order block on the weekly chart, so that's what I'm looking for. All right, so here's a 4-hour chart. What? 4 hour? Man, he done bumped his head. 4 hour? You ain't talked about a 4 hour in a long time, ICT. I know. And I felt like sharing tonight. Okay. I'm going to pull out the 4 hour chart when it's necessary. And it's necessary here because we have a whole lot of nasty price action on that daily chart. So I want to break it down into smaller, more refined ranges so you can see inefficiencies and better liquidity pools, which is why I said, yes, you can trade it, but it's just something that I'm not personally interested in trading at the time. I have lots of students that are beating this all up, but again, these are their markets. It's not my market. I've switched over to futures. So we have a small little gap in here after a shift in market structure, after the order block, and we had a lower high here. So there's a run up into a short-term premium with the inefficiency in the form of a fair value gap, sell side imbalance, buy side inefficiency. It hits the low of it, rejects it hard, and then creates another sell-off, another similar sell side imbalance, buy side inefficiency. It runs up, hits it. So what's institutional order flow showing you? Look close. Up close candle, the green one. Every candle on my charts that green is up close. So when institutional order flow is bearish, okay? When it's bearish, what we're anticipating is up close candles will cause the market to find resistance there. And we want to see down close candles be eviscerated. In other words, trade down through them. So this up close candle here, we see price on this candle trade up into it. And does it reject it, go lower? Yes. We open, we trade up into this candle's low, which is a up close candle, these 2 consecutive candles. Does the price reject it and go lower? Yes, it does. The market trades up into another inefficiency right in here. I'll talk a little bit more in detail about inefficiencies when we get into the lower time frames. I'm going to teach you a really deep dive charter level presentation on liquidity. So we have the run up into this inefficiency, it breaks lower, and then we have another break, hard, aggressive move here below that low. And this is for your notes, folks. There's a lot of cynics that come around and they try to appear in my comment section, which is another reason why I don't like to show my comment section, because I'm not given a stage for comedians. The notion is it's support and resistance when I'm trading. I'm not trading support and resistance. But if you were to look at that low right there, Tom, Dick, and Harry, or Frank's mentorship down the road, they're going to say this here, this low, draw that out in time. That's a floor, become a ceiling, and that's right there. That's classic support and resistance. This is how you know when classic support and resistance will work. You see that little inefficiency right there? That fair value gap right there. That's what makes that work, not simply because it goes back to that old low. So if you want to be a simple support and resistance type trader, if you use my fair value gap, you will qualify and quantify actual support and resistance from a classical stance. Okay, that's one of the things that I use to bridge, because I got beat up when I first started trading. And here's one of those points where I go down a rabbit trail, but I just want to toss in here because I thought the books were right. I spent a lot of money on those books and I trusted the authors. So I figured support and resistance is where it was at. And I could not pick the right support and resistance. And what high and what low, I would always get them wrong. So if you go back and through all your price data, look at all the times where an old high or an old low has a fair value gap, as I teach it. And if you have the bias right and you're on side, then you will be correct with your support and resistance ideas. Okay. So if that helps any of you, it may not, but if it does, that's what I'm trying to aim at. But I don't trade support and resistance. There's a real specific thing I'm showing, and you're going to learn a great deal tonight. Very, very high level, very deep expose of inefficiencies and liquidity. But we break lower. We had this sharp run here, and then we had this small little area here, and it doesn't fill in that area right there. Notice that? Now here's where the details are missed when you see other people try to teach my stuff. And folks, I understand that you like what I'm teaching and you want to go out there and you want to be an educator. You want to influence other people and you want to feel like you're empowering other people. You have to learn correctly before you start teaching it, because talking about it in hindsight is not enough. You have to understand what you're teaching, or you're going to hurt other people trying to learn it from you. And you're going to get high on the attention and not understand the damage that you're doing to people that are coming to you thinking that you understand something and you really don't. I have not fully taught all of this. There's a lot more things that need to be talked about. You can see some of the things and you can appreciate their existence and price action, but you have to understand there's a great deal of detail that is still yet to be revealed. I'm going to show you a whole lot of that tonight. I should have charged admission, really. But there's times where I teach, when I'm doing my live executions, you'll hear me either talk about it or I'll type it out. And I'll say, I want to see this fair value gap stay open or remain unfilled. It would be ideal for this gap to stay unfilled. That means it's not going to come back up to the high of it. And we're going to look at all this tonight, and we're going to look at it in great detail. But just know that between 108.40 and 108.60, around that 108.50 level or so, we're going to look at a lower time frame. Right now, this is a 4-hour chart. So we're going to drop down into a 1-hour chart, knowing that we have sell side liquidity here, and this is the draw on liquidity. I believe that's likely. And look at the bodies of the candle respecting this order block right there. See that opening price right there? Extend that through. All the bodies of these candles right here are holding price down. It's only wicking through it a little bit. These are like little mohawks, okay? Ultimately, price breaks lower. And then this candle, we open, traded back up, immediate rebalance, and then we're just marking time right now. So I'm watching this little candle wick over here, the tail of that candle. Midpoint of that is consequent encroachment. Extend that. I didn't put it on the chart on here because, again, this is way too much lipstick for my liking. But for you to understand and follow what it is, I have to do it. So this level halfway right there, I'm not saying that is, but you just get a measurement of the closing price and the low at a fib. The 50% level would be consequent encroachment. Extend that level to the right. If we fail to get down here, then I think it's going to at least go to that level there. Okay, so if I'm wrong, and it doesn't go here, it should at least try to stab into that consequent encroachment of this wick down here. So let's drop into the 1 hour candlestick. Now here's where the folks that don't know what they're talking about, okay, and I'll be honest with you folks, if that pisses you off and it offends you when I talk like this, you're just gonna have to warm up to the idea that I authored this stuff. And when I see other people trying to teach it incorrectly or pretend they know something when I know they don't, and then try to market it, it's offensive to me. And I have a voice in this because it's my content. I created it. So if you really want to warm up to the idea of knowing how to do this stuff, you're at the source right now. You're going to hear about it. You're going to see something tonight that hasn't been taught to you. You're not going to see it in their other stuff. Okay, they're 5-minute trainers. You're not going to get anybody to be able to condense this into a quicker version. So just roll your sleeves up and pay attention. This gap is based on the 4 hour chart. Okay, let me go up one more slide, okay, so we can get our calibrations. 109, big figure, that's this high here, and then 108.50 in that vicinity is this gap. So this red level here and this red level here, that's a 4 hour fair value gap, and these two levels are a 4 hour fair value gap. So let's go up one slide again. That's this, the 109 big figure, and the 108.50 level, that's in here, okay? So we're looking at this fair value gap on the 4 hour and this fair value gap on the 4 hour in a 1 hour time frame, because this chart right here, if you look up here, it's a 4 hour chart. So my next slide is a 1 hour chart. So here's that 109. We have the low of the 4 hour of this candle and the high of this candle, but the gap is formed on a 4 hour chart. When we see it drop down into a 1 hour chart, we have this inefficiency, yes. It trades up to it and reprices to the high. This is what you expect. You want to see it trade there and stop dead in its tracks. That is institutional order flow. Does it react to it and go lower? Yes. Then the market attacks what? What's resting below here? Sell side. The market does, in fact, go below that. Then it created in this run below that low, that 108.60 to 108.40 level, which is the 4 hour fair value gap. This is the high of the 4 hour fair value gap level. This is the low of the fair value gap on the 4 hour. This little inefficiency right here is denoting simply that candle's low and then this candle's high with that one big down close candle in the middle. Imagine for a moment, okay? Imagine that you understood that dollar was bullish and euro is bearish. And you were sitting right here where my cursor is. And you were shrunk down like Ant-Man in Marvel, and you were standing right at the point of my cursor. And then you looked left. What would you see? You would see this wall of price action right here. And then if you had x-ray vision, you could see there was two other panels or layers until you got to this old low and old order flow over here. So if you're looking at price action from this perspective, looking back, look how price has moved back and forth in here. You see that? And then on this one big candle down, you only had the separation between the candle's low prior to it and the candle after its high. That's what this little red shaded rectangle is. So on the 4 hour chart, this high of the fair value gap and this low of that 4 hour fair value gap, it does not need to reprice up to that high like it did here on this one. Why? Because you have this efficient delivery and balancing of price action. It's delivered to the downside. The next candle we open, trade up, and then trade back down. Right there by itself, that's balance for me. Then it throws you one more confirmation. We open, trade up one more time to it, and then rejects hard, leaving at this candle's close right here, that small little inefficiency right there. When you see me talk about in commentary while I'm taking a live trade and I'm typing out when I draw out the fair value gaps, I say, I want to see this remain unfilled. What you're not privy to is I have 12 monitors in front of me and I have 3 monitors to the right. And I have 2 small little devices, okay, which are like, they're Samsung, like they're not iPads, but I can't think of, they're tablets, that's what they are. It's 2 Samsung tablets. And I have a laptop that I talk to you all with my social media. When I'm typing in, or if I talk about it while I'm doing the trade, and I'll say, I want to see this fair value gap stay open and unfilled. It's ideal or optimal for it to not fill in. What you're not seeing, because I'm not trying to show every chart, I'm not trying to hide it from you, but my attention has to be focused on what it is I'm following. I'm not just simply looking at the chart I'm trading. I'm looking at all the lower time frames too, and I'm reading price action just like this. So imagine for a moment that 4-hour chart, let's go back up one slide. Man, I should have charged money for this. This inefficiency right here, right there. If I'm going short in that, I am telling myself that it should not go up there and touch the top of that fair value gap. It should stay open, unfilled. But let's just say that this was a 5-minute chart, not a 4-hour. And this was like the ES or any other market that I'd be trading, and show examples of me doing it where I type out and it never fills it and it keeps on running. How does ICT, how does Michael Huddleston know how to do that? There's so many people in the comment section that you don't see because I don't let my comments post anymore because, again, I'm not giving a stage for jerks. And I appreciate all your love and affection, but it's not necessary for everybody else to see that. It's for me, so just know that I read all of them. But this inefficiency here, let's say this chart was a 5-minute chart, not a 4-hour. And then we drop down into this time frame, 1 hour. So this would be like a 1-minute chart. Or maybe it's a 30-second chart, or a 15-second chart, or a 5-second chart. But ICT, I don't have that data. You don't need it. Just trade the time frames that you can. But on a lower time frame, less than 5 minutes, and it could be on the second chart, if I see in between those 2 ranges, the low and the high of the fair value gap, I anticipate trading up into and wanting to be short, I see this inefficiency here. I do not need or anticipate or expect price to go up to the high of it because it's already done this. 1, 2, 3. And then the small little inefficiency here. That's why it stops dead in its tracks in a consequent encroachment, which is half of that gap here on that candle there, and then stops at the low. And then you see it fail, leaving this portion open. That's real institutional order flow. These jokers that talk about volume profile in my comment section saying this isn't real order flow and you know what they're talking about, you have no idea what they're talking about because the market's not working off of volume profile. It's operating and delivering on an algorithm. It's coded to do this. And I don't care if you believe it. Okay. I'm out here doing it. I'm out here showing it and I'm teaching other people how to do it and they're doing it and they're making real money with it. So it's either the biggest conspiracy and collaboration of fraud of everybody being able to be right at the same time doing something. We're not really telling you what it is, or it's what I said it is, and they're all following it. So you decide what it is. Okay. The people are making money. I'm calling it live. They're trading it live. They're making money. It is what it is. You came here to learn. I'm teaching you. This is how I know when gaps are not going to completely fill, because on a lower time frame chart that I'm watching, and I have one specific chart, or not chart, but I have one monitor that I have that I call a matrix. Okay, it's an intraday matrix where it allows me to look at 5, 4, 3, 2, 1 minute candles, and then I toggle and I can go down into a 45-second chart, a 30-second chart, a 15-second chart, a 5-second chart, 1-second chart. So I'm looking for these types of signatures in every inefficiency I'm watching on price. So again, if this was a 1 minute chart and the 4 hour was like a 5 minute chart, the relationships that on the lower time frame, it's showing you delivery. This is real order flow. I do not need to see a depth of market. I don't need to see level 2. That's all gimmicks. Those things can be spoofed. You cannot spoof a candlestick or an open, high, low, and close bar. You can't spoof it. It's there. Everybody sees it. And it's time-based. The algorithm runs on time. So for the folks that have been dying and chomping at the bit, I've given you right here, this is the technique, the concept, the ICT blue ribbon seal of approval how to know when an inefficiency or gap won't completely fill. On lower time frames, you're going to be reading price action. And if you have all this back and forth movement, that's layering. So that's why I said if you were at the point of my cursor, shrunk down, like a miniature U, and you were looking to the left, you would see a wall of price action here, and another wall, and another wall before you get to the order flow. So it's already moved back and forth 3 specific hours of back and forth price action near the high end of that 4-hour fair value gap. So there's no necessity for price to go up above, really, this candle's low. And it doesn't even get to it there. It stops midpoint of that little small inefficiency right there. And then does one more time here, fails, slides. And then we work off of the order block in here. And this is what I said on the 4-hour, look at the bodies respecting and holding price at bay. And we broke down. There's a small little gap in here. We had that run up. And we have sell side building right here with that 107 big figure and 4-hour fair value gap that's shaded down here. But remember, rather, that there is a wick, the consequent encroachment of that wick on the 4-hour chart. It's somewhere in here. I don't know what the price level is. And to be honest with you, I'm not truly aware what that price level is. So you have to find it on your own on the 4-hour chart. And I know I'm probably confusing you. So it's this wick here or tail. Measure half of that and extend it forward. Okay, it's less than 107. I just don't know exactly what that price level is, so you'll have to determine that on your own. All right, here's the 15-minute chart of the euro dollar, and now we're getting down to the brass tacks of intraday price action, and we have the 2022 model right here. Stuff doesn't work, apparently it does every day, but you have a gap. Relative equal highs. What's resting above these highs? Buy stops. The market rallies up, runs through, engages the buy side, and trades into the inefficiency. Why doesn't it trade all the way up and touch the top of that? Well, what's this candle doing over here? It's one single pass and then one single pass. That's a balanced price range. That's why you don't get all the way up in there. So there's 2 different forms of knowing how I don't anticipate a full closure or repricing to a fair value gap, high or low, respectively. If it creates these balanced price ranges where it's one single pass and then one single pass in between those 2 candles, the high and low, the highest of the gap, which would be this here, and the lowest would be down here. So that's your that's your balanced price range between these two ranges. This one big, I know some of you are confused right now. I have a lesson coming for this. Do not freak out and stop trying to insist I teach it faster to you because you can't wait patiently. I have a lot of future lessons and I have an itinerary. I'm trying to stick to my itinerary. It's not have your way mentorship here. Okay, I'm not Burger King. So we have this run up in the buy stops. We hit it and then we price lower. So isn't this low taken out right there? Isn't that the 2022 model? We have buy stops taken here. And then we have a shift in market structure. Does it have a fair value gap? Yep. Order block, extend that forward. Trades up into it, breaks lower. Notice it doesn't completely close in the top of that fair value gap. Why? The order block stops it. There's a change in the state of delivery there. Then we have price break aggressively lower again, moving below this low. We have another inefficiency. Buy stops were taken here. Here's another model 2022. Fair value gap, trades up into it. The low of that candle. Now watch, this is for the order block freaks. Okay. These two up close candles are consecutive. That's a bearish order block. The low of that candle, extend that through. What is it in overlapping? Consequent encroachment of that gap, midpoint. It's real close proximity to that. So if we have a coupling or a confluence of these PD arrays, half of this gap, consequent encroachment. I already know some of you are freaking out that are brand new, like, man, this is too complicated. Keep showing up. You'll learn. I promise. It just takes time being exposed to it over and over and over again. You'll see it and you'll pick it up. But that low of those two consecutive up close candles, we have another inefficiency. Buy stops were taken here. Here's another model 2022. Fair value gap, trades up into it. The low of that candle. Now watch, this is for the order block freaks. Okay. These two up close candles are consecutive. That's a bearish order block. The low of that candle, extend that through. What is it in overlapping? Consequent encroachment of that gap, midpoint. It's real close proximity to that. So if we have a coupling or a confluence of these PD arrays, half of this gap, consequent encroachment. I already know some of you are freaking out that are brand new, like, man, this is too complicated. Keep showing up. You'll learn. I promise. It just takes time being exposed to it over and over and over again. You'll see it and you'll pick it up. But that low of those two consecutive up close candles, that is your order block. That's your change in the state of delivery. Why is that the change in the state of delivery? Because it's also in close proximity to the halfway point or consequent encroachment of this inefficiency or sell side imbalance, buy side inefficiency. There's only one pass through between this candle's low, this candle's high, that one candle there. Half of that is about right there, which is right at just about that low of that candle. Price stops dead in its tracks right at that order block where the change in state of delivery it occurs. Then it prices lower and takes the sell side out here. Let's go into a deeper dive with this right there. Just know that these two consecutive up close candles, that's my bearish order block. The change in the state of delivery is at that low. We're going to look at this candle right here closer on a lower time frame. Here's that same price delivery that was on the 15-minute chart, now on a 5-minute chart. It's anchored to what would otherwise be a random candle because you don't know what I'm showing. If I just showed you this chart here, some of you nod your head, yeah, I can see that. But without the context that I just gave you on the 15-minute chart, you're lost because you're going to look at this up close candle and everybody else with Tom, Dick, and Harry's mentorship, they're going to say, this is the bearish order block. And I'm going to try to sell short up here. And it never went to that order block. ICT is a fraud. It's fake. It doesn't work. Yada, yada, yada. And that's why you get these people out there saying that kind of stuff because they don't know how to do it themselves. 15-minute order block. It's parent. It's parent. This is subordinate. This is a 5-minute chart. It's going to be subordinate to the 15-minute candlestick chart. So the narrative is derived on the 15-minute. Then you look for signatures on the 5-minute to align with that. So this is that low of those two up close candles on the 15-minute chart. I'm extending it forward. Can you see visually how that's essentially half of this range right there? That's why it goes right up there and stops. Not because Gann said so, not because there was a wave that Elliott rode in on. It's not supply and demand. It's not harmonic. It's nothing else but the algorithm. Okay, the price goes right to that price level and stops dead in its tracks. Like some invisible force field said, no, you shall not pass. That's why this level here stays open. Doesn't need to go up there. Why? Because the order block is the change in the state of delivery. It stops right there. So that means all this price run up above these buy stops here, it goes above to engage those buy stops, yes. But does it go up to some random level? How do you know how far it's going to go when it's running stops? I'm doing this. This is technical science. I'm reading everything in the price action. This movement lower from this high down to that low, that's your price swing. That's your dealing range. And then you have to split that up. Equilibrium. So we went into what? A short-term premium. To some random level? No. A 15-minute bearish order block. That is the consequent encroachment of this fair value gap. So if it does that, runs up here and takes out the buy side, why would smart money want that? Because they're going to sell short here. What are they going to do with that? They're going to offset distribute their shorts by accumulating the sell stops below that low. And that's what you have right there. So smart money sells short. All through here, they're selling short. Selling, 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 selling. Up to that point, they stop. They can't assume any more because this is where they're being told this is it. That's the threshold. Then, as price goes down, they're starting to distribute. They're selling short, but they're buying back as price breaks down close candles. Right there. Rallies back up, and then right below that candle here, once it goes through that, they're covering more, and then covering right below the low where the sell side is. That's real institutional order flow. That's real order flow, Jack. Okay? Whether you like it or not, whether you like me or not, that's the facts. Okay? So it repeats. It does every single week, every single day. There's something like this always occurring. So let's go into more detail and really drive this home. 1 minute chart. Okay, Mr. Mop or whatever his name was in the comment section that says it doesn't work in Forex and it's nonsense marketing by ICT. There's some rules I gave you in that ICT Silver Bullet presentation. Okay, I gave you very specific tools to choose a high probability condition. I'm going to counsel you to go back and look at those rules. They are not cherry picked to make it work here, okay? The very first important slide in that presentation, I gave you some dialogue, how to anticipate a high probability silver bullet trade. There are parameters I've given you for Forex and futures. So whether you're trading index futures like I'm focusing my attention on now, or if you're still in Forex, or if you want to trade additionally Forex too, there's rules, okay? Forex, I like to see about a 15 pip range. So if it can move 15 pips, that means I can potentially take 10 out. That's the minimum. Okay, that's the minimum I'm expecting for a silver bullet for trading Forex. That is not to say that I'm only teaching you how to trade and get 10 pips. But I'm giving you high frequency trading methodology now, and these things repeat every single day. It's a time window that you can look for this to form every friggin' day. Every day. Even in sloppy, messy days that people say, oh, this is ridiculous. I can't trade this. You can. You can trade these, okay? But it's not imperative that you try to do it now as a new student because you're trading in very difficult times. And when these get better and the market loosens up a little bit more, and I suspect it probably will here in a couple of weeks, but when that occurs, you'll see a whole lot more volatility. So here's what I have here in reference to time. Okay, at 10 o'clock in the morning, again, this is Eurodollar. This is not ES, it's not E-mini S&P, this is a Forex pair. The market has buy-side liquidity. This buy side is that same buy side. Let's go back up to the 5-minute now. I don't want you to get lost. That's this here. Okay, this area in here. If we look at how highs have buy stops and lows have sell stops, like down here, I want you to think about that premise. Like this. This is, whenever I'm looking at price action, the first thing I'm looking for, the first thing is any inefficiency. I want to see, is there any imbalances like this one here and this, well, not so much on this one, but the 50-minute chart did have one. But any inefficiency like that one right there, see that? So when we look above old highs, we don't need to see a depth of market or a ladder or volume profile or anything like that to know there's stops above that. It's just common knowledge. There's going to be short sellers. If the market traded lower, there's going to be somebody that's short. And if they're short, chances are they're trying to protect or, hold some measure of unrealized profit if they're wrong. And below old lows, if the market has rallied, our assumption is that there's going to be sell stops below that. Somebody is going to look at that as a long position and they're going to place stops below that. How do you protect a long position? It's protected with a sell stop below some important low, they call it. Okay, so that's easy retail 101 logic. So what I try to do is I look at how I can take that and turn it upside down. How can I attack retail theory? How am I going to go in and go after Goober? Okay, Goober's in here trying to trade off of something he learned in a book, and he thinks he's figured out the whole idea of how markets move around, and he has depth of market, level 2 data, things are on the right side of his chart, passing through. He feels like he's technically inclined now, and he's still doing what? Putting stops below old lows and above old highs. So that doesn't change anything, okay? So I cut all the nonsense out of it and go right to the brass tacks of where's liquidity and where's inefficiencies, because that's exactly what the algorithm does, and it does it on a time delivery. Everything's by time. So when we drop down into the 1-minute chart, buy side liquidity, this high right here. Why this high? Why am I going to refer to this high here? Because when price made this low, it started from that high. Right in here. Now, I'm not talking about this high. I'm talking about this delivery, that little run right there. It stemmed right from that high. I want to see that high broken. If it does so here, then we have a shift in market structure. Well, why can't I use this one? You can if you want to be ultra aggressive, but it could fail on you. You could use this one, but it could fail on you. I want this one because this one is the parent price swing that sent it down here to take out the sell side right there. So I want to see that high broken on the upside. Trades into a fair value gap there after the shift in market structure. That, my friends, is what? Sell side taken, high. Why am I going to refer to this high here? Because when price made this low, it started from that high. Right in here. Now, I'm not talking about this high. I'm talking about this delivery, that little run right there. It stemmed right from that high. I want to see that high broken. If it does so here, then we have a shift in market structure. Well, why can't I use this one? You can if you want to be ultra aggressive, but it could fail on you. You could use this one, but it could fail on you. I want this one because this one is the parent price swing that sent it down here to take out the sell side right there. So I want to see that high broken on the upside. Trades into a fair value gap there after the shift in market structure. That, my friends, is what? Sell side taken, shift in market structure. There's your model 2022. It doesn't work. It's nonsense. Wrong. You can't read a chart. Fair value gap rallies up. Do a price swing measurement from this low up to the high with a fib using the bodies, not the wicks, because the bodies tell the story, the wicks do the damage. You will get that high. So model 2022, buy the fair value gap, first profit, buy side, and then see if you can get a runner into that inefficiency, which just happens to have that midpoint consequent encroachment and the 2-candle order block, the low. That's what that is right there. And you see how beautiful it is? It stops right there. It's almost like it's meant to be perfect. Anyway, then the market trades lower. But now I want to take you into a little discussion about the rules I gave you, okay? If you were buying this fair value gap, is this a qualified ICT silver bullet trade? Yes. Why? Let's assume for a moment that you're trading and getting in at 1.0782, okay, with spread. Does it move or can it move 15 points higher? Close, yeah, we're in there about consequent encroachment. So I would say, yeah, that would qualify. So it offers a potential for 10 pips. So this is, in my opinion, this would meet the minimum criteria right there, and you don't even have to have the 2022 entry. But guess what this becomes? That's a pyramid. What? Yep. That's a pyramid entry. I can take that. Why? Because from this low up to where I anticipate price can go, we're still not at a premium. Oh, so there's a time and place where I can do pyramiding, but if it meets a criteria that says, no, I can't, it's too rich, a premium or discount relative to the trade I'm in, then I can't add. I just have to stick to what I have and let it run. Yes. And I've said this in other places, not just here. Okay. There's a logic that I follow. Every single time I do these things, it's the same principles being used. You just don't know what they are because you probably watched a handful of videos and you're not keeping good notes, and you have to take notes, folks. This stuff is not going to be taught to you in a 5-minute training. They're not going to find a video or somebody on YouTube that's going to make this faster for you. They can talk with a lot less words and make shorter duration videos, but they're leaving out the real meat. They don't even know it yet. So this was a qualified ICT silver bullet for the long side, up into a fair value gap, inefficiency, and then the change in the state of delivery right there, stopping dead in its tracks. And the market breaks lower. We have a fair value gap in here. Now, notice this 10 o'clock. It forms and trades into it at 10 o'clock. Yes, you can trade that. That does not get a pass because the fair value gap has to form in between 10 and 11. This happens to go right into the gap that's right there. It's trading right into it at 10 o'clock. Remember, the entry must be taken between 10 and 11. The fair value gap can actually occur before 10 o'clock. The entry must be taken between 10 and 11. But what happens if I can get in at 11:01? You're not following the rules. But what happens if I can get an entry at 9:57? You're not following the rules. So whatever result you get, call it luck, because you're not following the rules. If you win, you messed it up. You got lucky. If you lose, you deserved it. How's that for logic? So now we have the market trading up into that order block where the change of state of delivery is where the price should stop. It's also consequent encroachment of the imbalance. This becomes what now? An inversion fair value gap. What? Yeah. Everything now shifts bearish. Moves lower. So now what can we use? We can use this low here. Why this low? Why didn't you use this low, Michael? Because this low only went there to that high. This low starts to run up into that inefficiencies, consequent encroachment, and the change in state of delivery where the bearish order block is on that. 2 consecutive up close candles on the 15-minute chart. That's what this level is here. So when we're running up into that low right there, that's your trigger for a shift in market structure. It does so here. So now we wait. Do we have an inefficiency or a fair value gap yet? No. 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 Yes. Never comes back up into it. So now we have what? We have a breakaway gap. Now we have a fair value gap form. This right here is an evolving silver bullet, just like I gave a video of. You have to know where price is wanting to go. If you don't have that, you're doomed. I don't care what you trade with, who taught you what indicators you have. I don't care, okay? Unless you know where price is trying to gravitate towards, everything you try to do or use is going to fail you. Write that down in your journal, folks, because that's the gospel. You will absolutely lose unless you know where price needs to try to reprice to. It's either running for liquidity, that means it stops, or buy stops above the old highs, or sell stops below old lows. So if we use that logic here, we're thinking that this is an inversion fair value gap. It's hit a change in the state of delivery in the order block. It's moving lower. We have a shift in market structure. No inefficiencies until we get to here, and it doesn't fill it. We have a inefficiency here, fair value gap, and we trade right up into it there. Right there is an entry. What would you aim for? Well, you have this low here, and you have this low here, and you have these lows down here. These are relative equal. But now you have to filter in that same 15 pip filter. From this entry, 15 pips lower, in this vicinity here, you could target that low. You could target that low here, and that would be a silver bullet entry, and that could be a first profit, and then see if you can get a runner to get the relative equal lows here. And it fills it later in the day in lunchtime at 12:15. So getting short here inside the gap, using a limit order. And I can talk this way because I gave it to you in a real execution. You watched me walk you through it. I called it. And the first fair value gap, like this one here, didn't fill. It didn't give me the entry. But I let the market evolve my setup into a lower silver bullet. And the spread alone got me in that. Go watch that video again. That you can't get any more razor precise than that. And it was not a market order. So I'm trying to tell you that just because I mark it in to show you examples, I'm trying to do that to give you a greater sense of comfort. Okay, because when I show really high precision entries and they're just really, really too good to believe, you get these jokers out there that'll say, oh, it's fake. I'm using an MT4 server, which I'm not using MT4, and then I'm gaming TradingView. I told TradingView to come forward and tell everybody I'm faking it. If I'm doing it, faking it, they can come out and tell me. Tell the whole world. They follow me on Twitter. You're listening, okay? The guy just reached out to me on the messaging system and emailed me too. Listen, you have my permission, okay? If I didn't take those trades that you're seeing and they're not real, you tell the world that I faked that, okay? Because believe me, if I was faking it, they would tell you. But that entry here runs the liquidity here and here. So entry here, and then you would be filled right there. Now these are not actual trade entries. I'm just showing you by where you would have the turning points, where your orders would be filled. So these are not executions. So I don't want you to read that and think that these are executions. They're not. What I'm referring to is a recording I did the other day. All right, S&P. We're going to go through this really quick because my battery's low and I didn't bring my cable down here. So we're gambling. So if it dies, just know that it's a cliffhanger. Order block, I think that we could potentially, if we get some really crazy movement lower, there's a lot of talk about debt ceiling not being raised and maybe default and all that stuff. If that occurs, that could potentially send us down into this area here and maybe lower. I'm not trying to predict that. I just had these levels. These are my points of interest on my chart now. On the daily chart, okay, we have a fair value gap we traded down into today, and the order block here on the daily chart, I have that noted. So I think that we could drop into that. How we trade there is important going forward. I like the fact that we went up in consequent encroachment on this wick here a few days ago and then worked lower. But this, in my opinion, is the last line of defense for the bulls. If we lose this area here, sell side down here is my interest. ES, the other day I mentioned on Twitter, I wasn't confident that we had a high. In place yet because I was looking at this divergence between ES and NASDAQ down here. That's what these are. But then we have a much more pronounced and prominent SMT divergence, which NASDAQ went higher, relatively speaking. S&P failed to do so, and we moved down into this inefficiency and the sell stops. That's a draw on liquidity. That's what you want to see in price action. All right, here is the hourly chart. I have a small little fair value gap in here. We trade up into that, work lower, bearish order block right there. Look at this, boom, 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 multiple times, and then displacement to the downside, trading into sell side, inefficiency as well, deep discount. This down here, This sell side has my attention if we use this as an inversion fair value gap. I don't know for certain what we're going to do tomorrow morning. I have to wait and see what we do at the opening. All right, so here is the 15-minute chart. Current new week opening gap high, current new week opening gap low. There's that fair value gap I mentioned. Sell side was taken. Consolidation inside of the new week opening gap, and then broke aggressively lower. Fair value gap, trade up into consequent encroachment. Remember that old idea of classic support and resistance? Here's that low. How you know that low is going to be support, turn resistance? Because you have the inefficiency right there. Trades up into it and then sells off down into the imbalance and fair value gap and sell side liquidity. Order block, 3 consecutive close. Candles, holding price back near the 70% level of the range that makes the new week opening gap. Sell side and bounce, buy side inefficiency, consequent encroachment, midpoint of that, sells off. Order block, look at the opening price there, hits it, delivery, inefficiency is what we're underneath right now. I don't know because I've been talking. We could be above this right now. I don't know what price is doing. I'm literally talking to you through a laptop down in my basement. My trading office is 2 floors up. So I'm watching to see what we do in tomorrow. I favor downside, but I don't know how we're going to deliver overnight. This is regular trading hours. Okay, there is the opening range gap here, and that's this shaded right there. Okay, and notice we only worked the lower 50% of that and left this portion open. So if it does trade higher, it will probably want to go up into this section of price action there. And if it does, then we could probably resume going higher if it finds support at the opening range gap high. Until we prove otherwise, until we get above new week opening gap low, I'm bearish. That makes it pretty simple, doesn't it? And here's the opening range gap on the 5-minute chart. Inefficiency is a sell side imbalance, buy side inefficiency. Consequent encroachment, which is midpoint of that, sells off. Order block that was on the higher time frame before I dropped into this one. And we're digging into that. So it needs, in my opinion, probably to run up into a short-term premium, and then want to see maybe another wipe out on the lows, because this is too smooth down here for me. I don't like those types of lows. All right, again, rules. You need to have 10 handles range. Here is 10 o'clock in the morning, AM silver bullet, to 11 o'clock. And this should have said 11 o'clock, I'm sorry. So 10 to 11. Here you have a fair value gap, trades up into it. Now, where is 10 handles from that point? 10 handles is at this low or lower. Can it get below that? I don't believe it can, because we've already had this low taken out with this low. And then we have a higher low, and then we have this low here. So we wick down into this, and we're inside of that opening range gap, and we're consolidating. So this would not be a silver bullet trade that could meet the criteria. We're gonna fall off, aren't we? It doesn't meet the criteria. So this is a silver bullet trade that could be scalped to take out these lows here, but not a classic ideal 10 handle setup. For the PM session, this one does. We have the order block trading up into it here, shift in market structure, ICT silver bullet here, a second one here if you wanted to go after it. 10 handles is this discount fair value gap. So from here to here, there's 10 handles or more. So this silver bullet and this silver bullet is high probability, and it delivers. So you have to know that there are rules to these things, folks. And you can't just simply say because you can't do it, it doesn't work. It's in there every single day. Every single day. And if you give behind the rules I gave you, it'll serve you well. That's it for this one. Well, I got time to say so. Thanks for watching, and until I talk to you next time, be safe. Here today. Take a look at this risk disclaimer before we begin. All right, so we are going to go over the dollar index. Euro dollar, and E-mini S&P again today. So yesterday evening, I did a live stream. You guys can find that recording on my YouTube channel. Every time I do a live stream, it will be added to the 2023 mentorship playlist. So that way you can find it there. If you want to look at the tab on my YouTube channel that says live, it'll be the one prior to this one. So if you have not watched that one from last night, it would be better for you to watch it, then come back to this one. Because otherwise it's going to seem like cherry picking, right? So here's the weekly chart here of the dollar index. And I mentioned last night that I wanted to see price draw up into the low and open specifically of this bullish candle. This is a bearish order block on the weekly chart for dollar index. We had that delivered today rather handsomely. And I mentioned that I would use this shaded area here, which is this fair value gap between this candle's low, this candle's high. I would treat it as an inversion gap, okay, or an inversion fair value gap. So in other words, it would act as support. And we'll take a closer look at that when we drop down in the lower time frame now. This is our daily chart. So that same weekly bearish order block opening price, I'm extending that here on the daily chart. You can see how today, for Wednesday, the 24th of May, 2023, you're going to hear all the ambiance outside, by the way. I'm out back. So you have the price opening and dropping down into Monday's high. Notice that? So we open, trade down into that shaded area. I told you they would be treated as an inversion fair value gap. So in other words, think of it as support. And more specifically, it trades to Monday's high. Now when it does this, it opens and trades down and goes right to that candle's high. That is my immediate rebalance. Whenever that occurs, that is very powerful in terms of, if you know where the market's going, put it that way. You have to have that obviously going forward. So if you don't know what the draw on liquidity is or where the market's likely to reach to, whether it be for stops or inefficiency for the purposes of rebalancing or repricing, the immediate rebalance isn't going to help you all that much. But if you do have a bias, and I shared mine last night, I told you that we would be looking for this very level here. It traded down into Monday's high. That's an immediate rebalance, and you can see the performance on the dollar index as a result, and subsequently after doing so. That lends well to weakness on euro and other foreign currencies. But we have to take it one step further. Just keep that in mind that when it hits this level here, this weekly bearish order block opening price, that's important because that was my target. Now I don't know what to expect going forward. I don't want to guess, and to be honest with you, I'm a little out of sorts today because my older boxer, I have 2 dogs, Bella, she collapsed today, so we've been an emotional wreck. So I don't have a great deal of clarity to be able to focus on what I think is going to happen going forward. So I'm just looking at what we've done today and just review it in that site. So again, we're not looking at the intraday for a dollar index. You're welcome to do that on your own charts. But on the euro dollar, the weekly chart here, I mentioned that we would likely draw towards this order block here. Wreck your own charts. But on the euro dollar, the weekly chart here, I mentioned that we would likely draw towards this order block here. And we had a little bit of movement towards that today. Admittedly, it was a little bit of a wonky session, and it was up and down, and we'll look into that as we drop in a lower time frame. Here's the daily chart. As I just mentioned on the dollar index, we're seeing the mirror image on euro. Okay, so our bias was bearish for euro and bullish for dollar, and we saw today we opened, we traded up to Monday's low, which is an immediate rebalance. Then price starts to go lower. Notice these 2 candles over here. They're relative equal lows, and then we have the fair value gap here in a net weekly bullish order block. So I still believe in favor this is a downside draw on euro, and it can still do that even if the dollar index this trades in consolidation. It could just find some further weakness on the downside. I don't see anything bullish here for euro dollar. That's what I'm getting at. On the hourly chart for euro dollar, you can see that Monday low, which is being shown here, and it's the immediate rebalance here. Intraday, we had the high here and high here, so that's relative equal highs, and that's going to be treated as retail resistance. Traders will see that, and we did in fact get the sell side liquidity pool targeted, as I mentioned last night in the live stream. That will be a downside draw. Then it rallied up, bumped, and engaged all the buy side liquidity there, and then again that Monday immediate rebalance on Monday's low for euro dollar. That's what this level is here. And then we had displacement to the downside. Now we have relative equal lows again, and I'm keeping this in the charts that way you can kind of like frame that 107-ish big figure level is still a draw in my opinion on the downside. Watch this inefficiency here, this sell side imbalance, buy side inefficiency, and we have relative equal highs. So it could stab up in there and then maybe resume lower. That's kind of like what I would expect going into Asia, into London. Okay, the 5-minute chart, going right into the AM session, and you can see how the market ran up into the Monday low. This is the immediate rebalance, and the market tapped it one more time, and then we broke a swing low here. So we had a shift in market structure, and then we have our time of 10 to 11. That's when we're looking for our AM session ICT silver bullet trade. We can use a fair value gap that's formed prior to 10 a.m. You would get this entry here. Or if you want to stick to only taking a fair value gap inside of the hour window of 10 a.m. and 11 a.m. New York local time, you would get this fill here. Both of them are good because the rejection block, even if we don't get down below these lows here, the rejection block is the lowest closing price. And you learn this in my PD array matrix in the core content for my ICT mentorship. All on the YouTube channel, so you can go and find it. If we have relative equal lows and you're looking for a target, it's many times better to have a partial, no, it's getting out with a profit at the rejection block if you have multiple wicks like this, because it could just go down into this order flow here where the bodies are showing it and not ever really break below the wicks, because the wicks do the damage. The bodies are where the narrative is really derived at. Okay, so it tells you the story. You can see that rejection block, which is the lowest of all these all these down close candles. The lowest one with the lowest close is this one here. That's why it is my rejection block. You can see it does in fact reach for that, and that price for the rejection block is 1.07506. And you're up here in the 72s or the 74s to get short on either one of these AM session ICT silver bullets. So is it more than 15 pips to offer a short? Yes. So it's significantly valid to take either one of these for a short. So again, for the guy that said it doesn't work in Forex, again, here's another example of that using the bias I shared last night. E-mini S&P, this is our daily chart. I mentioned that we would be bullish on E-mini S&P until we lost the mean threshold of the order block here and this fair value gap as well. They were like discount arrays I was looking for, and I said if we lost that, we would go down and clear up some of the sell side liquidity. And I'll take you into that chart and show you when we get in lower time frames. But we're going into a holiday weekend, and there's a lot of potential for things to go off. I'll just say it that way without saying anything more. For the folks that are familiar with me, when I talk on my Twitter spaces, I do sometimes refer to tinfoil hat discussions. This is a long weekend, and senators have been offered satellite phones, so you read between the lines. There may be some urgency for price to move lower and then sell that narrative. Okay, so it's at that fear narrative. And we do have relative equal lows here. So there's sell side remaining there. I think what we'll be doing tonight is most likely going into the opening range gap to close that in, and we'll take a look at that as now dropping in the lower time frame. Here's an hourly chart. These are the lows where the sell side would be rated. I said this in video last night, so you can go watch it. You know, about 10,000, 11,000 of you watch me talk about it live. And I said if we lost the mean threshold and the fair value gap up here, if it didn't offer support, this would be treated as inversion fair value gap. You can see we did go up, offered consequent encouragement here, and then sold off, attacking the sell side liquidity pool. And notice the bodies of the candles over here. See where all the bodies are stopping? Right at that low. So it's only going after that liquidity and then coming back up into reaching for a short-term premium. 15-minute candlestick chart. There's buy side liquidity pull up here. And this is this morning. We had news at 8:30. We had a sell side imbalance, buy side inefficiency here. We traded up into that, and then displacement to the downside, and then clearing up all those sell stops resting below that 41.20 level. In the afternoon, final hour of the trading, you can see that we had a shift in market structure here. Came back down into a bullish fair value gap. This is a buy side imbalance, sell side inefficiency, and order block. And then we started to see price rally back up into this fair value gap, but more specifically it's into the opening range gap. And I'll show you what that is. Here's a 5-minute chart, and for trading futures, there's a separation between sessions. And if you look at where we closed on Tuesday and where we opened here, using the regular trading hours tab on TradingView. Okay, this is how you get that information. Usually it'll say ETH, which is electronic trading hours. When you have it on a 5-minute chart or 15 or 1 minute or whatever, you can toggle it and it'll show you the gap that would exist as soon as we start trading the normal regular day session. So when we have that gap right there, it's likely to fill. But when there's a strong bias, and I was telling you what that bias was last night, I was suggesting that we would see what? Dollar higher up to that weekly bearish order block's opening price. That would send euro dollar weaker, and also it would put some willingness to see sell models come into the equities market. And we've seen, yes, there's a gap here, and usually it's a good idea to avoid shorting when there's a gap like this, but when there's a strong narrative in play, it'll usually go for the objective, which is that 4120 level. Again, watch last night's live stream, and that's where the sell stops and the rate on those would be if we lost the mean threshold that I mentioned for the S&P market. Because we had that gap lower and it was so close to getting down in to take those stops, it just opened, rolled right down into it, consolidated around here until noon. Why did it turn here? We'll get into that in a little bit, but right now just know that that turning point here at noon is something I teach anyway. But there's a confluence of events occurring there. Not only is it New York lunch, it's the midpoint of the day, and we had our objective met for the downside. And silver bullet, we'll look for that here inside of the 1-minute chart. Okay, we have up close candle here, which is a bearish order block after it's been broken. So a shift and change in the state of delivery. The market trades back up into that here during the 10 to 11 o'clock window. So for a 1-minute chart, you might look at this and say, well, I don't really see a fair value gap there, Michael. I don't see it, so therefore it doesn't work. No. If you listen to my Twitter spaces, and I've also mentioned it in the live session last night where I'm looking for inefficiencies and how I look at certain inefficiencies and know with a great deal of certainty that they won't fully completely fill in or rebalance because of lower time frames offering multiple passes in between ranges. Okay, and again, if you haven't watched last night's video or live stream, that's going to go right over your head and it's going to be of no help to you. But when you watch that video from last night, I go into great detail how to read real order flow. We're going to take this insight in what we're looking at with this bearish order block in between 10 and 11 o'clock. As I mentioned in last night's session and also many times in Twitter spaces, I don't look just at a 1-minute chart. So I have a intraday matrix where I look at 45-second charts, 30-second charts, 15-second charts, 5-second charts, and 1-second charts. That means every individual candle is as many as 1 second, 5 second, 15 second, 30 second, 45 second. So I go beneath a 1-minute time frame. If I know that I have a very strong bias, which is that 4120 level, and again, I pointed to that last night. If we lost the last defense for the bulls for EM and S&P, I said then we would sweep out this very level here. Okay, so if that's the draw on liquidity, and we saw that because we broke down, we lost all the last line of defense for discount arrays to send ES higher, and in fact we saw that supported with the idea that the dollar index was in fact reaching up into its weekly bearish order block, the level I mentioned at the beginning of this video and what I called for last night. Because of those factors in agreement, we could look at this area in here and break that down into a lower time frame. Even still, this is a 1-minute chart, so every 1-minute interval is represented by one candlestick here. This level here, this red line, we're going to look at that now on a 15-second chart. This is that same order block. Okay, So inside that order block, everything north of this line going up here, all that price action, we look inside that and we inspect it to see if there's any inefficiencies. And lo and behold, here we have it right there. So when the market tries to back up into that order block, it's not just simply because we're going into an order block that makes it a short. Just because it's going up into any old random up-close candle doesn't make it an ICT bearish order block. There has to be a narrative. That means it's going to want to draw down into the liquidity below 41.20. It's drawing up into a short-term premium. Algorithms can short only when it runs higher. That's how smart money operates. When it rallies up into this inefficiency, this fair value gap, they go short. Then the market starts to spool lower, attacking that sell side. So there's your AM, ICT silver bullet. As I mentioned, I don't just simply trade on a 1 minute chart. I can do lots of these types of trades all day long. And if I was showing it to you on a 5 minute chart or a 15-minute chart, you would be lost as to why I would be getting in and getting out, but yet still be profitable. It's these lower, very, very small time frames that I'm working with, and you can parlay your account up. Once you know what you're doing, even on ugly days, really choppy, messy days, if you want to go in and find your 5 handles, you can use this method here. Okay, so it's a way of dissecting and looking with X-ray view into predetermined level for either inefficiency or liquidity. In this case, I mentioned last night, if we lost that mean threshold on even the S&P, then we would go lower and sweep out that 4120 level where the sell side liquidity was. And we did, in fact, do that here. Is it a viable trade to take that? Well, if this stops at 4120, is it unreasonable to see it go down 3 handles below that? No, of course not. There's just liquidity resting below there. So if we went down to 4117.75 and assuming 4127.75 is where you'd be getting in at, what's the minimum criteria for a high probability ICT silver bullet trade? It's got to offer what? 10 handles. Can it offer 10 handles in range to get that move? Yes. So this meets the criteria. Okay, so the stuff works, folks. Ultimate delivers it right here a couple minutes after 11 o'clock, 10 handles from up here. You wouldn't see that unless you had the information that's being offered in a platform that offers these time frames. TradingView just so happens to offer that. So it's a really good platform. I like it. It allows me to teach, comprehensively, and a lot of my students use it too. So I know everybody else has these platforms of choice like NinjaTrader that offers these time frames, mean threshold on a short. So this is a 1 minute chart. So every 1 minute interval is represented by one candlestick here. This level here, this red line, we're going to look at that now on a 15-second chart. This is that same order block. Okay. So inside that order block, everything north of this line going up here, all that price action, we look inside that and we inspect it to see if there's any inefficiencies. And lo and behold, here we have it right there. So when the market tries to back up into that order block, it's not just simply because we're going into an order block that makes it a short. Just because it's going up into any old random up close candle doesn't make it an ICT bearish order block. There has to be a narrative. That means it's going to want to draw down into the liquidity below 4120. It's drawing up into a short-term premium. Algorithms can short only when it runs higher. That's how smart money operates. When it rallies up into this inefficiency, this fair value gap, they go short. Then the market starts to spool lower, attacking that sell side. So there's your AM ICT silver bullet. As I mentioned, I don't just simply trade on a 1 minute chart. I can do lots of these types of trades all day long. And if I was showing it to you on a 5 minute chart or a 15-minute chart, you would be lost as to why I would be getting in and getting out, but yet still be profitable. It's these lower, very, very small time frames that I'm working with, and you can parlay your account up. Once you know what you're doing, even on ugly days, really choppy, messy days, if you want to go in and find your 5 handles, you can use this method here. Okay, so it's a way of dissecting and looking with X-ray view into real order flow when you have a narrative, when the market's likely to go to a predetermined level for either inefficiency or liquidity. In this case, I mentioned last night, if we lost that mean threshold on even the S&P, then we would go lower and sweep out that 4120 level where the sell side liquidity was. And we did, in fact, do that here. Is it a viable trade to take that? Well, if this stops at 4120, is it unreasonable to see it go down 3 handles below that? No, of course not. There's just liquidity resting below there. So if we went down to 4117.75 and assuming 4127.75 is where you'd be getting in at, what's the minimum criteria for a high probability ICT silver bullet trade? It's got to offer what? 10 handles. Can it offer 10 handles in range to get that move? Yes. So this meets the criteria. Okay, so the stuff works, folks. Ultimate delivers it right here. Okay. So inside that order block, everything north of this line going up here, all that price action, we look inside that and we inspect it to see if there's any inefficiencies. And lo and behold, here we have it right there. So when the market tries to back up into that order block, it's not just simply because we're going into an order block that makes it a short. Just because it's going up into any old random up close candle doesn't make it an ICT bearish order block. There has to be a narrative. That means it's going to want to draw down into the liquidity below 41.20. So it's drawing up into a short-term premium. Algorithms can short only when it runs higher. That's how smart money operates. When it rallies up into this inefficiency, this fair value gap, they go short. Then the market starts to spool lower, attacking that sell side. So there's your AM ICT silver bullet. As I mentioned, I don't just simply trade on a 1 minute chart. I can do lots of these types of trades all day long. And if I was showing it to you on a 5 minute chart or a 15 minute chart, you would be lost as to why I would be getting in and getting out, but yet still be profitable. It's these lower, very, very small time frames that I'm working with, and you can parlay your account up. Once you know what you're doing, even on ugly days, really choppy, messy days, if you want to go in and find your 5 handles, you can use this method here. Okay, so it's a way of dissecting and looking with x-ray view into real order flow when you have a narrative, when the market's likely to go to a predetermined level for either inefficiency or liquidity. In this case, I mentioned last night, if we lost that mean threshold on even the S&P, then we would go lower and sweep out that 41.20 level where the sell side liquidity was. And we did, in fact, do that here. Is it a viable trade to take that? Well, if this is the stops 4120? Is it real order flow when you have a narrative, when the market's likely to go to a predetermined level for either inefficiency or liquidity? In this case, I mentioned last night, if we lost that mean threshold on even the S&P, then we would go lower and sweep out that 4120 level where the sell side liquidity was. And we did, in fact, do that here. Is it a viable trade to take that? Well, if this is the stops at 4120, is it unreasonable to see it go down 3 handles below that? No, of course not, because there's liquidity resting below there. So if we went down to 4117.75, and assuming 4127.75 is where you'd be getting in at, what's the minimum criteria for a high probability ICT silver bullet trade? It's got to offer what? 10 handles. Can it offer 10 handles in range to get that move? Yes. So this meets the criteria. Okay, so the stuff works, folks. Ultimately delivers it right here a couple minutes after 11 o'clock, 10 handles from up here. You wouldn't see that unless you had the information that's being offered in a platform that offers these time frames. TradingView just so happens to offer that. So it's a really good platform. I like it. It allows me to teach, comprehensively, and a lot of my students use it too. So I know everybody else has these platforms of choice like NinjaTrader and TradeStation. I'm familiar with TradeStation and all these other things that are available. I have to find a way to be able to meet the masses collectively, and I choose this medium. And when my community said use this as an alternative to MT4, I went here, and I'm glad that I did do that, because it allows all of us as a community to come together and see the same thing. I'm not all that proficient with using it. My students are teaching me all the time new things, but moving on. Now, when we got down below that 4120 level, this was the first pass here during the silver bullet trade. Notice there's no obvious inefficiency, right? Because we're looking at it on a 5-minute chart. But that's that first pass through. Then it trades lower, and then it goes down to 10 handles lower right there at that 4117.75 level. That's the low right there, okay? Then at noon, it makes the low of the day. At the same time, look what's occurring in the dollar index. Goes right up into our weekly bearish order block opening price. This right here, this right there occurring at the same time we're below on even the S&P, then we would go lower and sweep out that 4120 level where the sell side liquidity was. And we did, in fact, do that here. Is it a viable trade to take that? Well, if this is the stops at 4120, is it unreasonable to see it go down 3 handles below that? No, of course not, because there's liquidity resting below there. So if we went down to 4117.75, and assuming 4127.75 is where you'd be getting in at, what's the minimum criteria for a high probability ICT silver bullet trade? It's got to offer what? 10 handles. Can it offer 10 handles in range to get that move? Yes. So this meets the criteria. Okay, so the stuff works, folks. Ultimately delivers it right here a couple minutes after 11 o'clock, 10 handles from up here. You wouldn't see that unless you had the information that's being offered in a platform that offers these time frames. TradingView just so happens to offer that. So it's a really good platform. I like it. It allows me to teach, comprehensively, and a lot of my students use it too. So I know everybody else has these platforms of choice like NinjaTrader and TradeStation. I'm familiar with TradeStation and all these other things that are available. I have to find a way to be able to meet the masses collectively, and I choose this medium. And when my community said use this as an alternative to MT4, I went here, and I'm glad that I did do that, because it allows all of us as a community to come together and see the same thing. I'm not all that proficient with using it. My students are teaching me all the time new things, but moving on. Now, when we got down below that 41.20 level. This was the first pass here during the silver bullet trade. Notice there's no obvious inefficiency, right? Because we're looking at it on a 5-minute chart. But that's that first pass through. Then it trades lower, and then it goes down to 10 handles lower right there at that 4117.75 level. That's the low right there, okay? Then at noon, it makes the low of the day. At the same time, look what's occurring in the dollar index. Goes right up into our weekly bearish order block opening price. This right here, this right there occurring at the same time we're below the stops and inside that sell side liquidity pool marks the end of the day. We're done. So now what's it going to do? It's going to consolidate until the last hour of the day. Why? Because dollar has met our target. It's chopping around in here. Index futures are going to work towards going into what? Remember that opening range I showed you? There's a fly trying to land on me. This is that shaded area here on that opening range. In other words, this right here. So that's regular trading hours being shown on a 5-minute chart. On a 5-minute chart here with electronic trading hours, so you see the ETH down here in the lower right-hand corner. It's showing the price action on electronic trading hours. The last hour of trading, 3 o'clock going into 4, for the New York session, obviously it trades till 5 and stops until a restart at 6 p.m. for index futures. But we're seeing a displacement to the upside. There's a shift in market structure here. We have inbounds, fair value gap, and 3 consecutive down close candles. Order block, draw that out in time. Hits it, trades in the fair value gap here, and then works towards doing what? Getting up into that gap that it hadn't worked inside of all day. Remember, it opened here and spent all of its time down here. Shift in market structure after 12 o'clock, which is a normal time when we see what? A lunch reversal. With this gap up here, I'm expecting to see, and I don't know because I'm talking to you live right now, it's 5 minutes after 6. I would expect to see it trade up into 41.58, close that in, and then see if it's willing to go any higher, and maybe bump this liquidity here in that little gap there. But more specifically, I would like to see all this filled in. Now, let's assume for a moment that it trades up and hits that, closes it in, and then we start to fall again. Dollar would have to be going higher. And if that's the case, then we'll be looking for, let me go back up to we'll be looking for these lows here to be taken out. These relative equal lows on the S&P. So you guys got a chance to see me cherry pick in the future a daily candle, a weekly candle, and it delivered like we outlined last night. This stuff works. I don't know how else to prove it except for over and over and over again, showing it to you, calling it and outlining it, and it performs. The setups, you have to try to do your best to keep from wanting to be impatient to try to make money right away. And, you're going to learn patience by not trying to worry about the money, and learn, understand, and grow in learning how to know where these draws of liquidity are going to be. It doesn't happen overnight, and nothing I have, nothing anybody else has is going to be able to help you get there faster. You just have to keep showing up every day. I'll keep putting these out. I'll review. I'll show you the things that you should be seeing in price action, and you'll grow between now and November. So hopefully this was insightful to you. And until I talk to you next time. I mentioned it in the live session last night where I'm looking for inefficiencies and how section we look inside that and we inspect it to see if there's any inefficiencies, and lo and behold, here we have it right there. So when the market tries to back up into that order block, it's not just simply because we're going into an order block that makes it a short. Just because it's going up into any old random up close candle doesn't make it an ICT bearish order block. There has to be a narrative. That means it's going to want to draw down into the liquidity below 41.20. It's drawing up into a short-term premium. Algorithms can short only when it runs higher. That's how smart money operates. when it rallies up into this inefficiency, this fair value gap, they go short. Then the market starts to spool lower, attacking that sell side. So there's your AM ICT silver bullet. As I mentioned, I don't just simply trade on a 1 minute chart. I can do lots of these types of trades all day long. And if I was showing it to you on a 5 minute chart or a 15-minute chart, you would be lost as to why I would be getting in and getting out, but yet still be profitable. It's these lower, very, very small time frames that I'm working with, and you can parlay your account up. Once you know what you're doing, even on ugly days, really choppy, messy days, if you want to go in and find your 5 handles, you can use this method here. Okay, so it's a way of dissecting and looking with x-ray view into real order flow when you have a narrative, when the market's likely to go to a predetermined level for either inefficiency or liquidity. In this case, I mentioned last night, if we lost that mean threshold on even the S&P. Hello folks, welcome back. Hope you're all doing well. So here we have the weekly chart of the dollar index. And if you've been keeping notes, we've been pretty much calling this day by day, and you might have missed how it's performing as we're outlining each day. So just want to bring that to your attention. Many times people get caught up in the Netflix and chill aspect of ICT plethora of videos, but it's important to take notes, write down what we're anticipating, what we're looking for. That way you can go into your charts, even if it's just for back testing purposes. You'll be able to see what it is that you should be gleaning from the lectures and price action. All right, so weekly chart dollar index. You can see we traded up into more of this up close candle here. Now, initially I took your attention to the opening price, which we hit yesterday. And then I said we would likely see continuation upside, further weakness on euro dollar, and we saw that transpire today. So the next level on this up close candle is mean threshold. Mean threshold is the halfway point from high to low. Halfway point is here. That level comes in at 104.540. Okay, so that's your level. You should have that on your chart. If we have continuation on the upside, that's the level I'm looking for. Mentioned how we would use this imbalance from this candle's low, this candle's high. That would act as support and spring price higher. And we've seen that happen here. No Wyckoff required. All right, daily chart here on dollar index. Again, here's that weekly order block. The opening price is what that was. It's hard to discern what that is once we go into a lower time frame. So if I was just to show you this chart here with no reference on the actual weekly chart, it'd be a little confusing as to why I'm anchored right there when it's just really that I'm anchored on the opening price of, again, let me keep back up so that way you can keep track. That candle right there and the opening price is what this is, okay? So that's that right there. And we hit that yesterday. Then I mentioned we had this imbalance in here, and we also have a daily order block. This is this level here. Big up close candle right there in this time frame. Now let me go back one more time. See how we identified this up close candle prior to the rotation lower? The same thing now, we're applying that same logic to the daily chart. The last up close candle here, but the highest up close right there. That opening price is being annotated. And you can see we hit that today, which was just outside of the scope of this imbalance here. So dollar is a little bit overzealous, and we'll see if it wants to get up to that 104.54 level. I mentioned yesterday the idea of it opening, trading down to a previous day's high, not offering any opportunity for a deferred inefficiency, which is what a fair value gap is. I dubbed it a fair value gap is because the market moves away too quickly and it leaves an inefficiency by means of an imbalance in price. So since the candles are moving higher, the imbalance is buy side. So it's buy side imbalance, sell side inefficiency. So it's inefficient in offering down delivery or movement delivered on the downside. So price rotation on a liquidity continuum basis, meaning that the price is efficiently delivered between a range of price action. For instance, if we were to look at the range between 103.20 and 103.40, that's 20 pips for euro. It's moved up, down, in that range between 40 and 20 multiple times. Notice that? So if price has been moving back and forth between a defined range of 103.40 and 103.20, if we get a bias determined, which is what I'm sharing my 30 years experience with you, telling you that this is where it was going to go, and then higher still. If we ever get an opening on a candle and it drops down to a previous high, now normally if this would have stopped short, like say the low was up here and didn't go all the way down to Monday's high, that would create a typical deferred inefficiency, meaning that it would go to a fair value gap protocol, something like what we've seen. Well, let me take it back up one more time. This is a fair value gap between this candle's high and this candle's low, and that one candle on the downside. That low, that high, in between those two price points, price only went down. So it's a fair value gap, yes, but a specific category is a SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. So it needs to see what? To be efficiently balanced upside delivery. And that happens on this candle here. And then we opened and we were in this weekly candle. But I mentioned during this weekly candle's formation that we would use this as an inversion fair value gap. So it's typically viewed, if you would just watch a casual viewing of my videos and you would think, okay, well, he says if it goes up here, it's probably going to start going down. No, that's why it's important to understand narrative. That's mentoring. Okay, you only get that from me if you spent time with me, not just a few videos. You cannot assume by watching a few videos or watching anybody else try to do it, and parrot whatever I said incompletely. You can't learn that way. You have to have a length of time through exposure and seeing it over and over and over again, but ringing in narrative. That gives you a bias. That gives you a context, a framework for a trade. Without those steps in that order, you're not going to find a trade that's high probability. You're going to be lost in the charts and you'll just be frustrated. So let's go back down to the daily chart. I mentioned yesterday, if we see this formation, and this is what I dubbed a immediate rebalance. So we opened here, traded down to a previous day's high. It doesn't mean it's the previous day immediately to the left or yesterday's high. We're always referring to the essence of inefficiency and redelivery. Fair value gaps highlight those inefficiencies and opportunity for redelivery. So for instance, like take a look at this candle here. We have this candle's high, this candle's low, so there's a fair value gap. It trades